one of the key questions is really, are stocks in a bubble? I don't think stocks are in a bubble, but they are expensive.
Some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector.
Consumers are understanding, apparently, that what happens this year is not what we should expect next year.
It's pretty clear that whether it be the September meeting, whether it be Jackson Hole, the Fed is going to have to frontally address the tapering need.
We don't want to jar markets or anything, but I think it is time to end these emergency measures.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Just one more day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene taking a long weekend. Joining us, Kaylee Lyons. Good Friday morning. Equity futures 43.58 on the S&P 500, advancing about 7 points. More data, Lisa. Retail sales just around the corner.
The idea here is we actually are expecting a decline as you see that ongoing rotation from goods to services, with services perhaps the biggest wild card. How much are they picking up with the Delta variant, keeping people home more than people previously expected, John?
And we start this morning like we've started every single morning over the last couple of weeks. What are we doing down here at 132.38 on 10s?
I think that is the question that nobody really has a good answer for. Is it a Fed mistake? Is it stagflation? Is it this feeling that we're going back to a low growth environment? You know, the answer to that is really unclear. And frankly, I'm not sure what data points we're going to get that will actually give us any answers before maybe, I don't know, 5 years from now, John?
We need to talk a little bit about COVID too, don't we? You, me, Tom, we've been talking all week about the Delta variant and two things. How would policymakers respond? How would consumers respond? And Kaylee Lyons, we're getting a taste now for the policy response, not just in Singapore, but also in LA County in the last 24 hours.
Going back to indoor masks inside, John, even if you're vaccinated, and my question is, does the science say that that is actually necessary? And of course, I also, as it relates to COVID policy, am watching travel this morning, John, because the Biden administration says that it is expecting in the next few days to have a decision on the travel corridor opening up the other way, Europeans being able to come back to the U.S. It was just on Sunday, Lisa and I, on the same flight from Greece, landed here in New York. We had no problem because we're Americans.
You went out together and you returned together.
We did.
It was great. We held hands the whole time. It was fabulous.
I can talk more about that later if you want.
Can I just note one thing?
Please do.
So the Delta airline is having an issue with the Delta variant because it is an unfortunate name for them. So they just call it the variant now, John.
They call it the variant.
Call it the variant.
Are you going to call me Tom?
I'm going to call you Tom because it's Friday and that's the kind of day it is.
And you've just forgotten each other's names. Okay, 43.58 on the S&P. Let me whip through the price action for you and get you set up for Friday. Keep saying it. One day, one more day. We're almost there. Equity futures up 7. We advanced a little more than 1/10%. In the FX market, euro doing okay, 118 on euro dollar, positive 0.05%. And there's the move in the bond market. Yields higher on the session, but down on the week. Yields are higher by a couple of basis points, Lisa, to 132.38.
All right, coming up, we are going to be getting those retail sales at 8:30 a.m. We're expecting a decline. No drama, negative 0.3% decline. The expectation here is to see that ongoing rotation from buying stuff to buying experiences, services. I do wonder, though, to your point, John, to your point, Kaylee, about the Delta variant, how much that has unexpectedly suppressed some of the activity that we've seen in services. I also want to see if we have any clues as to why deposits have increased so much at the big banks, why people perhaps are not spending more. Then at 10 a.m., this may arguably be the data point of the day. We get U.S. May business inventories, but that's not the data point. We get July University of Michigan sentiment data. The expectation here for what consumers think about inflation going forward, it could potentially determine their behavior. And Fed Chair Jay Powell indicated that this actually was what he may be watching more than anything. What do consumers expect and how are they changing some of their behavior? And John, to your question earlier, why are Treasury yields so low? Will we get some answers in the May Treasury International capital flows, the tick flows that come out at 4 p.m.? These give you some indication of the foreign buying that we see in the Treasury market. A lot of people have been blaming this, frankly, for what we have seen with respect to yields going so low, because this is a high yield when it looks to Japan or looks to Germany, some of the European countries. How much has that really been the reason behind the Treasury yield move?
You're making a bold call this morning, though. You don't think retail sales, that data point, is the data point of this morning?
I'm wondering how messy it's going to be, given the rotation.
Okay.
I don't understand what exactly we can glean in terms of long-term trends. The thing that people are watching is the idea that perhaps the roll-off of some of the checks that people received, the stimulus checks in March, could lead to also a decline in spending. If that declines more rapidly than expected, that could give some indication of slack in the labor market as well. I'm not saying it's not important. However, Fed Chair Jay Powell really pinpointing consumer inflation expectations as being a real key driver of their view on price rises. And frankly, that has underpinned all of the price action in markets, John.
Lisa, well said. Looking forward to the data a little bit later this morning. We start with retail sales at 8:30 Eastern. We need to start this morning with the airline names. The airline stocks pre-market shaping up as follows. Since the highs of March on the airlines, we're down by almost 20% on S&P 500 airlines. For the individual names, this is the setup this morning. Delta, positive 0.6. United, up by about 1.55. And American, up by 0.49%. And Kaylee, the conversation, perhaps these names get some good news in, quote, several days.
Yeah, several days, John. It's still a wait and see mode when it comes to the Biden administration. I would note that we are seeing a bigger move on the European airlines. AIG, for example, is up more than 3% in the European session at this point, because we know on the continent trying to return this way to the North Atlantic, they have been waiting for this for a very, very long time, John.
Lisa, the president's quote alongside Chancellor Merkel, I'm waiting to hear from our folks in our COVID team as to when that should be done, relating to a question about ending the travel ban.
I'm very confused. All I can say is when I was going through passport control, there was a lot of yelling, a lot of confusion, people checking all of their news flows to figure out what the COVID restrictions really are and, frankly, where the pandemic even is. Yeah. John, what science are they looking at? What are they waiting to see? This is a great unknown that a lot of people are asking.
Well, hopefully they'll tell us in, quote, several days. Margie Patel joins us now, Wells Fargo Asset Management Senior Portfolio Manager. Margie, I'll start with a question I started this morning with Lisa. Your 10-year yield, 132.38. Why are we down here?
Well, I think we're down here because the Treasury curve is really, I think, kept suppressed by what the Fed is doing. They've anchored short rates low. They've been really buying a lot of the longer duration Treasury bonds long term. And so really there's no place for the demand for Treasury securities to go except the middle part. So you see a lot of expressing of emotion in the middle part. I think it shows people are worried about inflation, yes, but they're also worried about what if the economy slows down from deceleration or from COVID. Also, it is high, as you pointed out, compared to yields in the rest of the world. The dollar stabilized. So really, a 10-year at 130 plus or minus looks like a pretty decent investment.
So, Margie, based on your view that this perhaps is driven by what the Federal Reserve is doing, based on the fact that you could see foreign buying, do you count on yields remaining around here for the foreseeable future when you decide, you know what, equities still look like a buy?
Yes. Number one, because Chairman Powell has told us so. He thinks inflation is transitory. He wants to lengthen out that period where we look at even reducing the amount of purchases they're doing of treasuries and mortgages. So I believe what he says, they have the power to do that. And I think he's holding his breath when he thinks about what if we very slightly taper and we see some explosion in the marketplace. So I think they don't want to see that. They're going to keep on this course. What they think about inflation coming down is more important than what the market thinks. And also their other goal of employment. They still claim that there's a lot of slack in the labor market. So that gives them a lot of pace, even if inflation isn't really doing what they'd like it to do.
How important have earnings season been this year?
Well, I think they've shown what people expected, very, very strong in the first quarter. And I think we may once again be surprised in the second quarter to see earnings being much stronger than maybe we might have thought. We might have looked for a little bit of margin pressure. And my feeling is we're going to see companies continue to operate with less. Their sales are going up. They maintain their labor force costs either through productivity or just not hiring. So I think we may have another very pleasant surprise in the second quarter as we start to roll that out.
Not just over the course of this earnings season, but really since last earnings season, mid-March, we have seen the Russell 2000 down about 7% from its peak. And over the same time, the NASDAQ 100 is up about 13% over that time. What do you want to do with small caps now?
Well, I think that's a theme you see also in NASDAQ, those very, very large, you might say, high-growing safety kind of stocks, the FANG named, have so far outpaced the rest of the market. A good example was the airlines, which you cited. And I think that's typical. Lots of stocks, small cap or even some larger, are really down from their peak in March by 10, 15, maybe even 20%. And I think that shows that mixture is People want to be in the market, but they want something safe, so they keep sticking with the FANGs. The FANGs keep going up, and the rest of the market seems to be churning around, small cap, mid cap, or even large cap.
Margie, just quickly, and finally, you and I have had a chat about this in the past. Just how much cyclicality is left in this credit market? Does the cycle matter anymore to what's going on?
No, I don't think we have a cycle anymore. I think the Fed determines that we're on a, you might say, a secular path of low growth around a very, very low range of yields.
What a call. Margie, we've got to follow up on that another time. You know I'm fascinated by this call of yours. Margie Patel of Wells Fargo Asset Management, Senior Portfolio Manager. Lisa, we no longer have a cycle in the credit market. The Fed controls everything. The message from Margie Patel over at Wells Fargo.
I buy the argument. I have to just say that.
Well, I didn't think you'd be a seller of it, that's for sure.
Well, I think that there's an idea here, especially as we see a record number of upgrades relative to downgrades by the credit rating companies over the past couple of months, that basically the Federal Reserve saved companies that otherwise would have gone bankrupt. I mean, just the fact that they borrowed trillions of dollars of debt, and now they look so much better, even with the extra debt on their books, simply because borrowing costs are so low. Why are they so low, John? Because of the Federal Reserve. I mean, it becomes almost a tautology.
So, Katie, weigh in. Are we saying the data and the earnings no longer matters to this credit market? Is that the message coming from the likes of Margie Patel at Wells?
Has it mattered for some time, John? I mean, granted, spreads have widened out in July, but we're still at 282 basis points when it comes to high yield spreads over treasuries. And that the story, when you look at a one-year chart, John, is really quite remarkable. So I'm not sure anything fundamental has mattered that much to the credit market other than the Fed for probably over a year now.
This is the trouble that people have in this credit market, Lisa. I think it was JP Morgan that said it a couple of weeks back. Yes, spreads are super tight. Valuations are rich, but I'm not sure what would take them wider. What would take spreads wider from here if the Fed's still in the game?
And the concern about this, just to build on that, Delta yesterday announced that they were going to buy back $1 billion of pandemic-era bonds. This just shows they're taking their cash and they're putting it into that rather than investing in the future. What is the consequence of that overall for the economy,
We'll
John?
talk about this credit market with Robert Tiff of PGIM. We'll do that at 8 a.m. Eastern Time, the chief investment strategist. Just before, 30 minutes before, we get retail sales in America. Here's the setup this Friday. Equity futures 43.56, up 0.1%. For our audience worldwide, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden and China's Xi Jinping will address APEC leaders at a virtual summit on the pandemic today. APEC has 21 members, including the US, China, Japan, Australia, and Canada. While the coronavirus is a topic, the meeting is bound to reflect rising tensions between the US and China over a variety of issues. For the second day in a row, Federal Reserve Chair Jerome Powell defended the central bank's stance in front of lawmakers concerned about, well, inflation. Powell told the Senate Banking Committee that the reopening of the economy has driven inflation well above 2%. He reiterated the Fed's forecast that the high inflation will be temporary. And President Biden says the administration will warn U.S. companies about the risks of doing business in Hong Kong. He said the situation there is deteriorating and the Chinese government has not kept the commitment it made to the city. The advisory will warn companies about Hong Kong's new national security law, which prohibits anything construed as subverting the authority of the government. In Germany, at least 81 people have died in the worst flooding in decades. Many more people are missing. Belgium and other parts of Western Europe have also been hit. Several days of heavy rain forced rivers to overflow. People climbed onto rooftops and into trees after their houses were inundated or collapsed. China's Xiaomi has surpassed Apple to become the world's second biggest smartphone maker. That's according to preliminary estimates. Canalys, the research firm, says Xiaomi increased its shipments by 83% over the past quarter. Samsung had a 19% market share in the second quarter, followed by Xiaomi at 17% and Apple at 14%. I'm Rishika Gupta. This is Bloomberg.
This is a shock going through the system associated with reopening of the economy, and it's driven inflation well above 2%. And of course, we're not comfortable with that. This particular inflation is just unique in history. We don't have another example of the last time we reopened a $20 trillion economy. We're trying to both understand the base case and also the risks.
Good news for Chairman Powell, and maybe for you too. The two-day testimony is done. There's nothing from the chairman today. I know a lot of you, including the chairman himself, perhaps find it a bit tedious, but that is it. 2 days of testimony from the chairman behind us now. From New York City this morning, good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene out of the building. Katie Lyons helping us this morning. From the early surveillance edition to Bloomberg surveillance for the next couple of hours. Equity futures 43.53 on the S&P 500, advancing 1 single point and coming into Friday down about 0.2%. Big focus on the bond market. Yields coming up 2 basis points on a 10-year, down on the week, up on the session, just a little bit to 132.21 on 10s. The news out of Washington, D.C., we understood from the FT earlier this week we would have this advisory coming from the administration on the risk of doing business in Hong Kong. The president confirming yesterday in the news conference with Chancellor Merkel that would be coming. Reuters alluding to that this morning, Lisa, suggesting that that advisory is out today for U.S. business.
A lot of uncertainty still about how much this will have teeth. In other words, how much will the U.S. administration truly go after companies for acting in ways that they are uncomfortable with in Hong Kong? And frankly, we're not hearing from businesses a great deal of concern just yet, John.
To use the president's words, Kayleigh, it is more of an advisory as to what may happen in Hong Kong. It's as simple as that, and as complicated as that as well.
Yeah, maybe just putting it in words, John. We aren't expecting the U.S. Biden administration to say companies need to pull out of Hong Kong, that they need to pull back their investments in Hong Kong. I guess just be aware of the situation in Hong Kong, and the Biden administration is going to tell you more about that.
Let's head down to Washington, D.C. to get some clarity. Anne-Marie Hordern, our Washington correspondent, joins us. Anne-Marie, I'll use the president's words from the news conference yesterday. The situation in Hong Kong is deteriorating, and the Chinese government is not keeping its commitment that it made, how it would deal with Hong Kong. One country, two systems, that feels like a long, long time ago.
Yeah, exactly. The president in this advisory really is just warning. And what the president said, that's all it is. It's an advisory. We're not telling you you have to stop doing business in Hong Kong, but we want you to know that what the risks are. And one of the things that this advisory is supposed to outline is really the legal risks now that the Chinese Communist Party has an entire really grip on Hong Kong. That's one of the things to keep out for, and that the Biden administration is that these businesses need to keep in mind. Some of the legal threats that now are more subject to the Chinese Communist Party in mainland Beijing than would normally be on how they normally dealt with Hong Kong.
Anne-Marie, I got to say, find me a CEO that says, wow, I had never realized that about Hong Kong. I wasn't aware of the dynamic that was percolating between the mainland and Hong Kong. What is the purpose? Is this purely messaging to the Chinese government that basically if they start cracking down on data and they start cracking down on U.S. IPOs of Chinese companies, that the U.S. will retaliate with these types of measures?
I think part of it is messaging, especially after we saw what happened with Didi, which many U.S. investors were a part of, given that IPO in New York. I also think part of it is they do want to map out the framework that there has been a change in Hong Kong. And we've seen that since last year with the national security threat law, what's happening in terms of press freedoms in Hong Kong with the Apple Daily Edition. So there are a number of things that have been stacking up. But of course, as you say, Lisa, it really is just another layer of the tit for tat we are seeing between Beijing and Washington. And while many were potentially expecting a softer tone from this administration on Beijing, it is not happening. They have kept all of those guardrails in place from the Trump administration, and they are going even harder.
And the Biden administration has the backing of Congress. I mean, this is the one bipartisan issue that we know that they agree upon, and we're hearing some agreement on putting money behind competing with China's Belt and Road. What's the latest on that in terms of how it gets rolled out and how much teeth there is behind that?
Well, just yesterday, the House Foreign Relations Committee advanced a bill. And as you say, there is bipartisan support in Washington when it comes to wanting to especially invest domestically in terms of being able to compete with China. This bill yesterday actually had a little bit of pushback from Republicans because they didn't like that there was a little bit of working together with China in terms of climate initiatives. But at the end of the day, there is support. And this is about making sure there's infrastructure also to make more chips in the United States, also to help other countries in terms of countering the Belt and Road Initiative, which President Biden spoke extensively about with G7 leaders in Cornwall recently while on his trip to Europe. And the other thing, of course, is that the United States is working potentially with other countries about a digital trade pact, and this would be 100% to deter China and just another way to combat China. But again, the difference between, and you could differentiate the Trump administration and the Biden administration, is that they're both talking tough on China, but President Biden clearly wants to do it in a multilateral approach.
So, Anne-Marie, while we're talking about U.S. adversaries, you have China on one hand, you have Russia on the other. Did we glean anything about the united Western approach to Russia from Biden's meeting with German Chancellor Angela Merkel yesterday?
They didn't really go into details regarding Russia in the sense of Nord Stream 2, except for the fact that they both agree that they should work hand in hand in terms of wanting to make sure that Russia does not use Nord Stream 2 as a way to coerce and to use their energy supply against Europe. This is something that President Biden said, although we are friends, you tell your friends the truth, and that he did bring up his worries about Nord Stream 2 with Chancellor Angela Merkel. But basically, at the time he got in office, the pipeline was pretty much done. I mean, that pipeline is more than 90% done. It's going to be done by the end of August. So we didn't get details, though, of what reassurances Germany is going to do to really protect Ukraine. And it's quite awkward for Merkel, I have to say. Her district in Germany is where these Russian vessels are floating and the end of this pipeline. But we do know that they at least had a united front in terms of how they could work together to deter the Kremlin.
Anne-Marie, that's the issue here at play for so many people, and Katie's right to go there. That news conference started yesterday with the President of the United States celebrating the tenure of Chancellor Merkel. This has happened on their watch. When we talk about the end of one country, two systems, the risk, the advisory coming from this administration, this has happened on their watch. What can they actually do about any of it to change the path we're on now?
Well, when it comes to Russia and Nord Stream 2, there's really nothing the United States could do except potentially to really sanction some of these companies that are in the final layers of building that pipeline, or sanction Germany. That is not something the administration is going to do because, of course, Germany is an ally and there's a lot of transatlantic trade and partnership there. But they do want to keep a closer eye on it, and they really are at this point just stuck with it. But Germany is also, and Europe is also in a precarious situation. Russia is also their direct neighbor, and it is where they have to get their energy supplies. I think right now what the Biden administration wants to focus on, at least, how do we protect the economic and national security interests of Ukraine.
Anne-Marie, good to catch up. Our Washington correspondent down in Washington, D.C., Anne-Marie Hordern. Lisa, these issues are going nowhere anytime soon.
What it does highlight, though, is that the fractures between Germany and the U.S., once very close allies, have not necessarily been breached post-President Trump. And this, I think, is going to be an ongoing theme with President Biden.
They're very good at singing Kumbaya, though, and holding hands, aren't they? There's a clear disagreement on some big issues there.
How much are you buying Kumbaya? Think they have campfires?
I don't think so. Lisa Abramowicz, Kelly Lydes, Jonathan Ferro, Tom Keene back with us on Monday. 43.54 on the S&P from New York City this morning. Good morning. This is Bloomberg. Live from New York City for our audience worldwide. Friday morning, good morning. Here's the Friday morning price action. Equity futures 43.54 on the S&P, advancing about 2 points. On a session up by almost 0.1%, coming into Friday, down about 0.2% on the S&P and on the Nasdaq too. Just a bit of weakness came through for big tech yesterday. The Nasdaq 100 positive this morning by almost 0.1%, but also down on the week by 0.2% after 8 straight weeks of gains for big tech and the Nasdaq 100. Coming into this week. Switch up the board, a check on the bond market, 2s, 10s and 30s. Your yield's just a little bit higher. Ending last Friday, though, at 135.95. We're lower on the week, higher on the session. We're at 132.21 now on 10s. And this is happening even with CPI and PPI coming in a little bit hotter. CPI hotter, PPI hotter, a dovish chairman of the Federal Reserve, Jay Powell, and yet still, you can't get lower yields on the week. You've got to pay attention to this market. It's fascinating to see how it's responding to the data on any given week. And this week, it's meant yields lower. This is what I want to finish on, though. The airlines on the S&P 500. Switch up the board and get to the chart. Over the last year, up a tidy 51%. Since the March highs, though, down almost 20 percentage points. So there's a broader theme and a much more laser-focused theme I want to zoom in on in just a moment. The broader theme, what's a reopening trade and what's a durable cyclical play? Because right now, that chart behind me looks more like a reopening theme and not a durable cyclical play. We can come back to that a little bit later. The thing I want to zoom in on, though, is these airlines need some good news. And Lisa, I wonder if that good news can come from this administration a little bit later. We know all about the domestic travel story. We're familiar what may or may not happen with business travel. We need to find out what happens with international, because that New York-London corridor is so important to some of those airlines.
It's such a mess. That's the technical term for it. And Kaylee was right to point out the international airlines are actually benefiting more from this news, but you do have to wonder whether that's enough to get people going again and to get travel restarted. I will just also note there is a question of the hangover costs for some of these airlines as they deal with pandemic-era issues, whether it's just their standards or if it's the debt overhang. You know, this is one of the key questions this week as well, which is what happens to markets if the dollar materially strengthens from here. We were talking about dollar weakness, the expectation for that being part of this recovery trade. That's gotten turned on its head, and how damaging could a persistently stronger dollar really be? Bipin Rai, CIBC Capital Markets North America head of FX strategy, gets this question, I am sure, every day from his office in his home, where he is itching to get back to his work office and away from home politics. I am sure as many people are. Bipin, thank you so much for being here. What's your sense in terms of how offsides traders would be if the dollar materially strengthened from here?
I think there's a bit of that. I mean, certainly if we look at some of the positioning gauges, that are a lot more prevalent in the FX world, they're still highlighting the fact that the market is still quite short the U.S. dollars. And I think, if you do get this sort of sense from the Federal Reserve towards August, September, that they're looking towards tapering their asset purchases, a lot of traders are going to be caught off guard. And if you do see that dollar squeeze, we expect that to materialize against some of the other majors out there.
What's the argument for it to weaken materially from here, given the fact that a lot of central banks have made it clear the Fed has to be the first mover?
Right. So you hit the nail on the head. It's whether or not the Fed is at the vanguard or sort of lagging the move a little bit. And that's the risk that we're monitoring at this point. And certainly that requires us to pay attention to incoming data, especially unemployment and inflation, and also what FedSpeak says as well. I mean, if it does seem like the Fed is going to drag its heels with respect to tightening monetary policy, then you know what? Those dollar shorts don't really look as out of place, and the dollar will take a little bit longer to recover, maybe even go on the defensive as well.
This dollar weakness story that didn't develop, I find absolutely fascinating, Bipan. The high for euro dollar was this year, the start of this year. Euro dollar 123.27 on January 6th. Now, Bipan, many people thought that was just a starting point, and from there, euro dollar could push back towards 130. The dollar could continue breaking down. And just for our audience that aren't in your world, Bipan, traditionally, if the rest of the world starts to do better, that's a weaker dollar environment. That's a weaker dollar dynamic. Just what has gone wrong this year with that theme?
Right. I mean, that was a theme to pay attention to earlier this year, especially for Q1 and Q2. But again, I think what a lot of people tend to forget, especially with respect to the euro, is that fiscal policy matters as well. And effectively in Europe, we're talking about them reverting back to the old fiscal policy or straitjacket of old, and really looking at curbing spending and debt limits as well going forward, whereas you don't really have that same sort of straitjacket in the United States. And again, FX doesn't respond to fiscal policy as much. It's usually a story about monetary policy. But guess what? If you get that stronger impulse from fiscal policy in the United States, monetary policy doesn't need to be as accommodative over the long term. And I think that's the problem with Europe, is that a lot of people are starting to understand that the ECB is going to need to be accommodated for a lot longer because there isn't as great of a fiscal impulse there. And that really has caught up to the euro, and that's one of the reasons why euro dollar is on the defensive. And certainly, notwithstanding the mandate shift that we saw last week, we do think that the ECB is going to be on hold for longer, and the Fed is sort of, albeit at a slow pace, pivoting towards more hawkish policy. That really, to us, suggests that there's a ceiling for euro dollar into the immediate term.
We're talking about the economics. Let's talk about the politics just briefly. I want to bring you some headlines. A little bit earlier this week, we had some understanding that we would get an advisory from the administration on the risk of doing business in Hong Kong. Reuters reporting a little bit early this morning that advisory was out. We can confirm that here at Bloomberg, that the United States has issued that advisory about the risk to operations in Hong Kong. Lisa, just one line reads as follows: risks faced in China increasingly present now in Hong Kong. I think this is really formalizing some communication from this administration that the era of one country, two systems is over. Yeah. And I think that's important to recognize that this morning, that is a very, very formal recognition from this administration that that's the case.
What do CEOs do with this, though? What do legal counsels advise them that they haven't in the past using this? Is this just the beginning, the opening warning salvo, or is there going to be more, John? And I think that that's going to be crucial.
I'm with you. And Kaylee, I've said continuously, when you speak to multinationals, when you speak to the leaders, the C-suites that run these companies, when you ask them about these issues, Katie, they don't want to talk about it. They do not want to risk their access to the mainland.
Yeah, it's a very good point, John, but I do wonder if this advisory is really aimed at those C-suites at American companies, or if this really, at the end of the day, is a message for Beijing as it relates to China's policy in Hong Kong.
Let's build on that. Bipan, great to have you with us. Let's talk about it. And I want to ask you about the specifics of this release from this administration this morning. I want to understand from your perspective where we are with US-China relations and what it means for your world, the FX market.
So far, we haven't seen much of the political interference really imply anything for the dollar CNH rate. It really has been more of a function between the dynamics of growth so far. Again, mid-2020 up until earlier this year is really a story about a stronger renminbi, really driven by what's happening onshore in China in terms of the domestic recovery and how that contrasts with the United States. Now there seems to be a little bit more of a concern with respect to the credit impulse in China. We're starting to see the renminbi weaken a little bit. And also that's commensurate with other commodity currencies being on the defensive as well. So it's primarily a story based on economic growth. I wouldn't tie it to politics at this point in the FX space.
Have the rumors of China's slowdown been greatly exaggerated? We saw those better than expected retail sales number earlier this week, and you're starting to see growth forecasts being revised upward now.
All right. I think to an extent, there is somewhat of a concern that is merited at this point for China, given the fact that we did hear about them earlier this year, interested in curtailing some excessive credit that was out there. So, I mean, I don't think, they were overplayed. I do think there's a sense of, yes, there could be some slowing momentum onshore in China. So again, it's a mix of both, and I wouldn't want to lean too much into really suggesting that a lot of this isn't merited. I do think there's something there.
All right, so I want to come back to the dollar, and our colleague Kriti Gupta on the MLive blog just put out a macro view column saying the dollar and yields were on the same page until they weren't. What do you make of that weakening correlation?
Well, to us, it suggests really that, again, there does seem to be this growing sense of concern with respect to global growth prospects in terms of, that's probably leading the bid towards the long end and helping to flatten the curve to an extent. Whereas you're seeing sort of a different dynamic with the U.S. dollar in terms of really this being more of a position cleanup play more than anything in anticipation of a hawkish Fed potentially in August, September. So I really think there's two different factors weighing both in terms of FX and rates, and you can't really rely on the same degree of correlation as before.
Bipan, good to catch up and good to see you. As always, Bipan Rice, CIBC, Capital Markets, North America Head of FX Strategy. Just want to bring you that news for the last 10 minutes. Bloomberg reporting now, together with Reuters and many others, that we have that advisory from the U.S. administration on the risks of doing business in Hong Kong, with the following quote from the State and Treasury, Homeland Security and Commerce Departments. The quote reads as follows. Developments over the last year in Hong Kong present clear operational, financial, legal and reputational risks, Lisa, for multinational firms. And to Katie's point, Lisa, I think it's a really important question. Who's this for this morning? The multinationals operating there, or a warning shot to Beijing?
And you have to wonder also what follows it. And I think that will give you an answer in terms of who this warning was for, because I doubt anyone in the C-suite or frankly anyone in the regulatory front in any of these companies is going to say, wow, this is shocking. Who knew of these risks, John?
Yeah, I'll be interested to see if you actually get a response from any of the companies that operate on this advisory this morning. The other issue that we haven't touched on, and it's related to some of this, that tension between the US and China. We talked a lot about Didi in the last month or so. There was a Chinese company tapping US capital markets for a significant degree of cash, and then the regulator at home clamping down on things. And it really raises the risk about doing business here in the United States, never mind in Hong Kong. And Kaylee, additional reporting from our team at Bloomberg suggesting that maybe mainland China, Beijing, is opening the door now for those IPOs to go to Hong Kong and avoid coming to America altogether.
Yeah, the cybersecurity regulatory review now, you're going to see exemptions for it potentially if you do list in Hong Kong. So China clearly trying to get companies to list there where, in theory, they may have some more control, not in the U.S. And we've seen this not just with Didi, John, but earlier this week, Lala Move, which is a Chinese delivery and logistics company, reportedly was planning on listing in the U.S. and is now moving that to Hong Kong because some of these regulatory fears, and now China obviously trying to entice that a little bit more.
Broader story, Lisa, pretty clear, isn't it? Different administration, same issues. Will a different approach, if we could call this a different approach, actually generate a different result?
And what is the result that they ultimately want? I mean, that's sort of unclear. You talked about how the sort of two different countries, one system idea doesn't really work. I also will argue it also shows how much data and the fight for control over it very much is at the forefront of all of these tensions.
Very much so. We've got to talk about this pandemic too. Just a baby step backwards in LA County. you're going to have to wear a mask indoors, even if you've been vaccinated. We need to talk about that change in Los Angeles in just a moment. We'll do that with Andy Pekos there, Johns Hopkins University professor and virologist from a beautiful New York City this morning. 43.55 on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In California, Los Angeles County told residents they must wear masks indoors even if they're vaccinated. Authorities are reacting to a surge in COVID cases and the spread of the highly contagious Delta variant. LA County added 1,000 new cases yesterday for the 7th day in a row. 10 million people live there. The UK is holding out the prospect of restoring some of its pandemic restrictions. That comes just 3 days before it plans to drop all social distancing rules. The number of people hospitalized in the UK with COVID has risen 43% in a week. The country's Solicitor General told Sky News that if the situation becomes, quote, unacceptable, some restrictions could be reimposed. In Cuba, the communist government is promising it will learn from the rare mass protests over the weekend. Authorities will temporarily ease restrictions on food and medicine imports. Thousands of people took to the streets to demand freedom and food. Cuba's economy shrank 11% last year. White House officials meet today with representatives of the home building industry to address the housing shortage. Builders, labor unions, lumber companies and loggers will be amongst those attending. Builders have said that high prices for materials, scarce supplies and a shortage of skilled workers are their biggest problems. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are preparing whatever the circumstances is, and the success of the games lies in the excitement and emotion created by the competition of the athlete. We are accelerating the pace of vaccination as much as possible. Vaccination was a bit delayed compared to other major countries, but we are accelerating dramatically.
Yuriko Koike there, the Tokyo governor from New York City this morning. Good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene back on Monday. Katie Lyons dropping by to help us out with some of this price action. Let's get through some of it. 43.58 on the S&P, up by 6 points, advancing a little more than 1/10%. Into the bond market, just a bit softer this morning, firmer on the week, softer on the session. Yields higher by a couple of basis points to 132.21. Euro dollar rolling over just a little bit, but holding on to a 118 handle. Euro dollar negative, almost 1/10% to 118.03. We've talked a lot about this Delta variant. We've talked a lot about what may or may not happen with the policy response. Here's the policy response from LA County, reintroducing a mask mandate for indoors, even if you're vaccinated. And this is what the county's health officer had to say. Quote, "We have to get these numbers down. Masking by all makes it a lot easier for this to happen, and it adds that layer of protection for fully vaccinated people." Lisa, I guess the issue here is for fully vaccinated people, do they want that extra layer of protection? Is this something they want to do? This feels like a step backwards, a small one, but nevertheless a step backwards.
And what's the messaging? Is it that the vaccines are less effective and that basically people need the protection? Or is it that we don't trust people to verify that they've actually been vaccinated? So let's just have everyone wear a mask and be done with it, John.
Yeah, the communication around getting vaccinated now, Kaylee, with these kind of measures, I think Lisa's right. It blurs things a bit.
Yeah, it does. And remember, John, when the CDC first put out the guidance that, hey, if you're vaccinated, you don't need to wear your masks anymore, that was seen as enticing more people to get vaccinated, that was the aim of that effort. Hey, you can take your mask off if you get your shots. Now you're saying you have to put your mask on even if you've had your shots to protect the people that haven't had their shots. It just gets very, very complicated, John.
Let's bring in the expert to try and get rid of some of this complication. Andy Pekos, Johns Hopkins University Bloomberg School of Public Health professor and virologist. Andy, simple one from me. What on earth is going on?
I think you have to look at the local conditions. And in places like Los Angeles County, you're seeing a massive surge in cases. This is driven by Delta variant infection, but importantly, it's being driven by infection of unvaccinated people. So when you've got a high level of community spread, even if you're vaccinated, it's a good idea to have one more layer of protection because the vaccines work, but they're not 100%. So masking and vaccination will help you, especially in a condition where there's a high likelihood you're going to come into contact with other infected people.
Andy, can you clear this up? I got a message this morning saying that one of our listeners and his wife have curtailed their vacation because of the Delta variant, that they have changed their behavior. I don't know if this person is vaccinated, but I know I've talked to friends who are, and they are curtailing their vacation schedule. Is this what people should be doing? Should they be less mobile, even if they're vaccinated, for fear of contracting the Delta variant?
I think it really depends on, in this case, where you're going. If you're moving to an area, or if you're going to an area where you know there's a high amount of COVID-19 cases, it's probably a good idea, if you're going to go, continue to wear masks and think about social distancing in those ways. If you can put it off, I would put it off. The Delta variant is really a scary variant in terms of how quickly it's moving in the population. Again, if you're vaccinated, you're protected, but you never want to rely on just one thing, particularly if you know that there's going to be a high number of cases around.
Andy, you can understand the confusion around here. We're being told the vaccines are incredibly effective. They're even effective against the variant. And then you have health professionals, including yourself, saying it is a scary variant. You should be more careful even if you're vaccinated. What is the potential consequence for vaccinated individuals if they do come into contact with the Delta variant?
The outlook is really good. So even if you're vaccinated, you have a much less likelihood of getting infected, much lower likelihood of even symptomatic disease, and an incredibly low likelihood of getting severe disease, meaning hospitalization or death. So the vaccines are working. The data seems to indicate they're working well against the Delta variant. So you're in a good situation. I think the data that's going to be coming out soon is going to be essentially pretty clear. When vaccinated people get infected, they pick up the infection from unvaccinated people. So more and more, we're seeing that the unvaccinated population is posing a general risk to the population with respect to whether or not you're vaccinated or not. So this really comes down to, I think, a better method of communicating the safety and the efficacy of the vaccine so we can get that vaccination rate up. That's going to solve a lot of our problems.
So, Andy, if you were advising the Biden administration right now, President Biden yesterday said he's waiting to hear from his people basically about reopening travel with Europe and that we should have an answer in the coming days. Would you tell him not to do that given the concerns around the Delta variant?
I think travel is the lower end of the concern here. We've got the Delta variant here. We need to think about ways that we can limit the spread of this virus here in the U.S. One of the things that I think might be important for us in terms of gaining more trust in the vaccines is to get full FDA approval for the mRNA vaccines and the J&J vaccine here in the U.S. I think there are a lot of people that are waiting for that final stamp of approval before they jump in and get the vaccine. We need to move that forward faster to really reassure people that the data that we're seeing here about safety and efficacy is really overwhelming, and there's no reason for us to keep using these emergency use authorizations. We should just flat out approve these vaccines.
Well, we're also waiting to see if there is going to be emergency use authorizations for children under 12. Do you expect that in the near future, especially as we get closer and closer to the new school year?
Absolutely. I fully expect that the mRNA data, vaccine data from both Pfizer and Moderna is going to show really good efficacy in those younger populations. And again, those children and schools are going to be the critical thing right now as we think about the fall. We expect to see a bit of a surge in the fall anyway as people move more indoors. And schools are going to be an environment where the virus spread could be maximized. It's great to see the data showing that kids are less susceptible to severe disease, but they're not resistant to disease. So we do have to think about protecting those populations, especially if we're going to put them in situations where virus spread is going to be more optimal.
Andy, we've got about 30 seconds. What would it take for you just to endorse a position of individual responsibility and move away from these broader societal measures?
Again, I think it comes down to vaccination. I can't stress enough how wonderful the data is on vaccine safety and efficacy with these COVID-19 vaccines. They're successful beyond the wildest dreams of any clinician or scientist would have said a year ago.
Yeah.
We've got to find a way to get this into the population more broadly.
Andy, let's hope that move in LA County doesn't move things the other way. Andy Pekosh of Johns Hopkins, thank you, sir. Things get more confusing, Lisa. That measure over in LA County is a double-edged sword.
There's an idea here of, should we just be afraid forever? When is the end? If people feel like they are reaching the end and they're vaccinated, why do they have to go backwards? And you do wonder at what point, as you asked, when does it become an issue of personal responsibility?
What's the incentive if we're going to be masking forever? We can talk about this through the next couple of hours. From New York City this morning, good morning. For our audience worldwide, 43.57 on the S&P. From New York, equities advanced a little more than 0.1%. This is Bloomberg.
One of the key questions is really, are stocks in a bubble? I don't think stocks are in a bubble, but they are expensive.
Some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector.
Consumers are understanding, apparently, that what happens this year is not what we should expect next year.
It's pretty clear that whether it be the September meeting, whether it be Jackson Hole, the Fed is going to have to frontally address the tapering need.
We don't want to jar markets or anything, but I think it is time to end these emergency measures.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a fascinating week. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene back with us on Monday, helping out with the price action. Joining us this morning, I'm pleased to say, Katie Lyons. Your equity market, 43.60 on the S&P, just south of that level. Retail sales, Lisa, 90 minutes away.
More of a sense of how much people are spending, whether the stimulus checks that people got in the mail in March are rolling off, and how much that's affecting people as they go out and do experiences, perhaps, and how much the Delta variant is slowing that down.
Yeah, that's been a big issue this morning. We'll build on that in just a moment. The additional issue, Lisa, we've been waiting for it, the advisory from this administration on doing business in Hong Kong.
And this has been a steady drumbeat. I mean, frankly, it's been several weeks of the Biden administration taking a particularly hard line against China. You wonder at what point this will affect Chinese businesses, at what point this will affect U.S. businesses that do a lot of transactions over in that country. Frankly, we spoke with Marriott's chief executive officer this week. He said, we're monitoring it. We have a company out there. It's basically a Chinese company. It won't affect us that much. Really?
It's not something they want to talk about.
No.
Kaylee, you asked the right question. Is this for Corporation USA or is this for Beijing?
It is the question. I'm waiting to see what, if anything, we get in response from Beijing, John, because this just continues to be a ramping up of tensions, of rhetoric, of shots back and forth across the bow. And I really do question whether or not the Biden administration means them, those in the C-suite, to take account of this, to change their behavior because of this, or if this is him really just sending a signal to Beijing, hey, watch out, we are monitoring your behavior in Hong Kong.
We'll monitor it and head down to Washington in just a moment. Let's head to the price action right now. Your equity market set up as follows coming into Friday. Futures look like this. Equity futures up 7, advancing almost 0.2% to 43.59, approaching 43.60. Outside of that, yields are higher by 2 basis points to 32.21. And euro dollar, Lisa, euro dollar just about holding on to 118 flat. Euro dollar negative 0.1%.
I got to say, I'm watching the euro weaken versus the dollar, and I'm ready to go back to Greece. I know Kaylee is going to be right there with me on the same flight out as we did last time. Coming up, as you mentioned, in about 90 minutes time, 8:30 a.m. U.S. June retail sales. How much of a transition to experiences from buying goods? That is one key question. How much do we actually already see the bleed through of the increase in the Delta variant, and how much people may not be spending going out to eat or going on vacations because of that? Then at 10 a.m., I am really interested to see what the July University of Michigan sentiment data shows when it comes to inflation expectations. There have been a number of academic studies showing that when people expect inflation to increase, it is more likely to increase. They change their behaviors accordingly, and it has a basically pile-on effect. How much are we going to see that in today's data? And we know that Fed Chair Jay Powell is watching this closely. And then to answer the question, why are Treasury yields so low, there is the potential answer of, is it just foreign flows? We're going to be getting the Treasury International Capital flows later today at 4 p.m. How much do we see an increase in buying from Germany, from Japan, and other places that have yields so low that the U.S. relatively looks like a high-yielding nation, John.
High yield at 132. That's the world we're in right now, isn't
Incredible.
it, Lisa?
Yeah, and it really raises a question also of how much of a signal this has on the economy. People talking about, is it pricing in a Fed policy error in tightening too quickly, or is this a sign of stagflation, of the inflation that we're seeing now actually leading to slower growth down the line, John?
That's the bond market. Let's turn to the airlines. Kaylee, you've been on top of this all through this morning. Can we get some good news for the likes of Delta, United, American? Pre-market, they're positive 1% on Delta, 0.6 United. On American Airlines, we advanced 0.7%. What's in store from this administration, Kaylee, in, quote, several days' time?
Well, we'll see what's in store, John. Biden is waiting to hear from his people on whether or not they would recommend reopening the travel corridor, going the other direction, allowing Europeans to come back here to the U.S. As we said, Lisa and I did this on Sunday, coming from Greece back to New York. No problem at all. If we were Greek trying to come to the U.S., we wouldn't have been able to do that. The question is that going to change? And of course, the Biden administration always calculating the Delta variant into that equation, John. So I think it is still an open question. I'll get back to you in a couple days.
Well, you make that important distinction. Lisa, what's the science behind that distinction? I think that's what a lot of people would love to know, even if the rules don't change.
Yeah, and what's the consistency? In other words, how much could we potentially get a reversal if the Delta variant picks up? I got to say, in conversations with friends, with other parents, people are really worried about the school year and what happens if the fall does bring a resurgence in cases, John. We just don't have an understanding of what the threshold is for this to become a public health threat.
I know that's a personal issue for you, getting the kids back to school.
Just
this
theoretically.
September.
I'm just talking theoretically.
No, of course.
100%.
I'll get to the bond market just for you as well.
Thank you.
Some people might be interested in what's happening in yields, 2s, 10s, 30s. Here's the board right now. Your 2-year yield up about a basis point to 23. Your 10-year yield up a couple of basis points to 132. On 30s, up 3 to 195. We don't talk enough about what's happening with the 5-year yield, and that's where the action, the party has been over the last several months, if you want to call it that. Yields are higher by a couple of basis points. Some of us are entertained by it, Lisa. Approaching 80 basis points on 5s. Our next guest thinks that 5-year segment of the curve is where you should be focused. Daryl Kronk of Wells Fargo Wealth and Investment Management, the CIO, joins us right now. So, Daryl, first question to you. Why?
So the short side of the curve, most people don't realize the 5-year Treasury has gone up fourfold. It's gone from 20 basis points this time last year to 80 basis points this morning. As the Fed expectations and a more hawkish Fed starts to get priced into the short side of the curve, we think that's where you have to pay attention. There's less of the QE effect. Everybody wants to stare at the 10-year, and understand a basis point move here or there. But watch the short side of the curve in the second half of the year, because we think that will tell you where economic growth goes and how quickly the Fed will begin either tapering or not tapering. Along with that, though, John, too, I would also put in, the other indicator you should watch is the U.S. dollar. We think it's the most deep liquid market. If the 10-year and the long side of the curve is getting affected by what the Fed's doing around tapering, then the dollar becomes a much more important barometer for the second half.
Let's stick with the 5-year for 1 second. If you zoom out, what is this area of the bond market telling us with respect of whether the Fed is going to commit a policy error, whether they're going to hike too quickly, and that is what is behind the decline in longer-term yields?
I think you're exactly right, Lisa. So the market is priced out an inflation overshoot, and they've priced in the fact that the Fed overreacts and aborts the recovery in some regard, right? So that's where we stand today. That's why rates are where they are today. That, along with term premiums, have come in, particularly on the long side of the curve, which just means that for those term premiums to widen back out, you need the Fed to be right. Inflation needs to be transitory and start to subside, meaning growth can take back over. The Fed doesn't have its hand forced. And that will drive what we see in either steepness or shallowness of the curve in the second half.
So that's the bond market, Daryl. How do you factor that into your calculation for the equity market? When you think about these inflation concerns, how do you approach portfolio construction?
So we very much like equities. This is a great environment, Kaylee, for equities. I mean, a 132 10-year Treasury with profits where they are, negative real yields where they are. You have to be long equities. We think that you get a stronger bullish reaction in the second half than most people expect. Everybody expects growth to subside. I would say, though, what you want to think about here is shortening your equity duration, just like you shorten your bond duration. What does that mean? That means owning companies that have high shareholder dividend yields, high buyback yields. So places like energy, industrials, materials, right? The classic cyclicals. You can own tech here, but you want to own large cap tech that have high amounts of cash return to shareholders. That's the place to be in equities in the second half of the year. And it also protects you somewhat if rates do start to move back higher again later into the year or into 2022.
Daryl, a second wind is what you're looking for then for the cyclical trade. What's the catalyst for that?
That actually we think that the Fed is correct, right? That inflation is transitory. You have some sticky months in here. And going back to the earlier point, it forces or allows the Fed, in essence, to not be as hawkish, not throw the recovery off its tilt, and you get a growth steepening of the yield curve, basically, and growth persists into 2022. We still think U.S. GDP next year is well over 5%.
Daryl, good to hear from you. Good to see you too, as always. Daryl Kronk, Wells Fargo Wealth and Investment Management. This has been a story, hasn't it, Lisa? It feels like an inflection point, the big debate. Where does the leadership come from in the next leg of this equity market? And what does the back half, the back quarter, the final quarter of this year look like?
And right now, the consensus seems to be that we already saw the peak growth kind of trade fade. We saw basically peak expectations for yield curve steepening. So is the consensus, are we at a point, John, where the consensus could be that we are not going to get this reflation trade the way people had expected before? Could the consensus be for big tech in a way that perhaps sets it up for the reversal later in the year?
I hate to complicate things, but I think the consensus right now is that the consensus broke down. If you look at the bond market at the moment, can you find a consensus in the bond market as to why we're down at 132? And the reason every single morning I ask the same question every single day is because I get basically a different answer to what's happening. I'll catch up with Priya Misra of TD a little bit later this morning. She's making the point that this is just a positioning story.
Honestly,
Lisa, and that's been the story over the last few months.
I'm laughing because I'm thinking of the derivative of the consensus. And if Tom were here, he'd be talking about the delta and the gamma of the consensus trade. Look, I agree with you. However, there does seem to be a consensus. We're not hearing as many calls for 2.5% 10-year yields or 3%.
That's true.
So perhaps that's the one takeaway we can have.
Should we stop using the C word for the next 5 minutes? No more consensus.
We could just make it a drinking game.
We could. Drink. Enjoy. Katie Lyons, the race, the battle in the equity market. You've covered it. I have. Lisa has. Tom, sometimes. The NASDAQ versus the Russell. The small caps versus big tech. And the NASDAQ started to take the lead recently. This week's been interesting.
John, you went right where I was going to go without using the C word. The trade everyone thought coming into the year was small over large, and that has totally flipped on its head from the peak of the Russell 2000 back in March to today where we trade now. Very, very interesting dynamics. The C word was wrong maybe for now, John.
Very true. If you're just tuning in on radio and TV, it's so Bloomberg surveillance that the C word on this program is consensus. There you go. I think that tells you a lot. Yes. 43.59 on the S&P, advancing a little more than 0.1%. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The Biden administration today warned U.S. companies about the risks of doing business in Hong Kong. An advisory said that China's push to exert more control over the financial hub threatens the rule of law and endangers employees and data. Today's move underscores how quickly that Beijing's promise of one country, two systems in dealing with Hong Kong has, well, come to an end. For the second day in a row, Federal Reserve Chair Jerome Powell defended the central bank's stance in front of lawmakers concerned about inflation. Powell told the Senate Banking Committee that the reopening of the economy has driven inflation well above 2%. He reiterated the Fed's forecast that the high inflation will be temporary. In Germany, at least 81 people have died in the worst flooding in decades. Many more people are missing. Belgium and other parts of Western Europe have also been hit. Several days of heavy rain forced rivers to overflow. People climbed onto rooftops and into trees after their houses were inundated or collapsed. BJ Solomon is the latest Wall Street firm to raise salaries for young bankers. The new salaries range from $100,000 for first-year analysts to $225,000 for third-year associates. Citigroup, JP Morgan Chase, and Barclays are amongst those who have also increased pay for junior bankers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
unemployment is at 4.5% at the end of the year and things are progressing the way that I'm expecting, I would guess that some adjustment would be in order somewhere in that time frame probably, but it's going to depend on the data. That's the whole point.
Another week of Fed speak. Charles Evans there, the Federal Reserve Bank of Chicago president from New York City this morning. Good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene back with us on Monday. Katie Lyons with us for the next hour or so. Your equity market looks like this. 43.58 on the S&P, advancing 6 or 7 points, up a little more than 0.1%. This bond market, Lisa, what a week again. Let's talk about it just for a moment. 132.38. Yields higher by a couple of basis points on 10s.
The amazing thing is this comes on the heels of higher than expected inflation prints yet again. We got the CPI, we got the PPI, we got, just this sense of manufacturing in the Empire region, New York State region, where the input prices are climbing to all-time highs. You start to wonder whether this really is the turning point this week where everyone buys the transitory story.
Do you think they do? Do you think we are building towards a agreement, consensus on what's happening in this bond market? There you go.
Cheers.
There you go.
I mean, honestly,
do you think we're moving in that direction?
I think that that's what the market is implying. I'm curious to see whether analysts are going to change their tune, because we still speak to people who expect the 10-year yield to get up to 2% by the end of this year. I wonder what the catalyst would be, given that any taper talk is met with further flattening in the yield curve and lower 10-year yields.
That's 68 basis points away at the moment. Let's bring in Wendy Benjaminson and head down to Washington, D.C. Bloomberg Deputy Managing Editor for U.S. Government. Wendy, good to catch up. We've been waiting for that advisory from the administration to corporations doing business in Hong Kong. It's out. Who's it for?
That's an interesting question.
It's Kaylee's question, not mine, Wendy, which is why it's an interesting one. So please help us.
Congratulations, Jeremy. It is ostensibly designed for businesses who the Biden administration says it is concerned is not taking the risks of doing business in Hong Kong seriously enough. Obviously there's a lot of money to be made in Hong Kong, but you would think the companies have people who are telling them that, about the national security law and what the risks are. And so I think the Biden administration is signaling this as part of its tougher on China stance, where it is adopting some of the Trump administration actions toward China or policies toward China, and trying to show that it is tough on China as it begins its foreign policy push.
Wendy, that's exactly where I wanted to go. I was hoping that you could put into perspective this directive. In other words, in the trajectory of different China actions that President Biden has taken, do we get a better sense of what the ultimate goal is by the Biden administration against China?
Yeah, I mean, he says that he wants, he says he wants the relationship to improve and to work as strong competitors against each other. I think that he's also stemming off in the midterm elections and for 2024, the Republican note that, Biden will be soft on China, that he's, there are already ads running showing him, looking warmly towards Xi Jinping, but that is a problem for him. And so I think he's been trying to address that.
How successful has he been in tightening the alliance back up with European allies? And I speak about this in the heels of the visit by Angela Merkel to the White House.
That's right. She was here yesterday. They had a joint news conference in which they talked about the areas where they disagree, for example, on Nord Stream and on the travel advisories for Americans going to Europe during COVID. But they also, they also really worked hard to repair any rifts that were caused during the Trump administration. And there were areas on the Nord Stream gas pipeline where they agreed that they would both be tough on Russia if Russia tried to interfere, but they also wanted to, help Ukraine make the money it does from the gas coming through from Russia to Germany. So, they were trying very hard to repair those alliances. They do have some differences over China, and that's yet to be worked out.
When we talk about China, also President Biden is trying to pitch infrastructure spending as a way to compete with China, in addition to being a jobs engine and everything else. When it comes to those two infrastructure packages in question, we heard from AOC, the Democratic progressive representative from New York yesterday, saying that she would basically crush the bipartisan package if those other measures, the more, social measures, don't get pushed through by the Senate. Are the progressives going to be a problem here?
Yes. A problem for Biden. It depends, of course, on your perspective on that. But the whole thing is devolving into this arcane congressional procedural mess that, even us in Washington sort of roll our eyes about. What's happening now is that the bipartisan infrastructure framework, known as BIF, that is the bipartisan bill that Chuck Schumer, the Senate Majority Leader, wants to start having votes on Wednesday. And many senators are saying, hold on, I haven't seen the fine print yet. I'm not sure I want to vote on that timeline. And yet House Speaker Nancy Pelosi is holding up the budget reconciliation bill until this is passed, and vice versa. So they're all in this thing about which one's going to get passed first. And Alexandria Ocasio-Cortez yesterday, did say that progressives would tank the BIF, the bipartisan agreement, if they didn't get their social spending and climate spending, which is important too, in the reconciliation bill. So right now, they're playing chicken on the highway.
Business as usual on Capitol Hill. Also, when it comes to the specifics within these bills, what about the SALT cap? Because I know the people listening and watching here in New York probably care a lot about that.
Yes, they do. I'm sure they do. It looks like there might be some relief for that because there are the New York, New Jersey, Connecticut delegation are very interested in getting some relief on that $10,000 cap on state and local taxes off your federal taxes. So they are looking at, getting some relief on that. The trouble is that takes away revenue, which means some of these expensive social programs don't get paid for.
Wendy?
So.
Wonderful,
Yes.
as always, and good to catch up. Thank you. Wendy Benjaminson, the Bloomberg Deputy Managing Editor for US Government. Believe it or not, I want to spend a couple of minutes talking about social etiquette. Yes, me.
I'm shocked.
Talking about social etiquette. And the difference between the first question you ask in the UK and the first question you ask when you meet someone in America. In the UK, this is what we do. What's your name? This is what we do in America. What do you do? And people ask you, what do you do? So they can place you. Now, when you ask that question next, in perhaps a bar in New York City, and they turn around to you and they say, I'm a first-year analyst at a bank on Wall Street, then you know they earn $100,000 a year because Citigroup, Barclays, JP Morgan, Guggenheim Partners, and now PJ Solomon, Lisa, they're all in on this. $100K is your first year's salary out of school, and it's been up near that level anyway, but these banks are all getting together and pushing it higher. $100K. This talent retention push is huge.
Just to be clear, the first question is, what's your name? The second question
is
what do you do? And then what neighborhood do you live in? I mean, basically, you can
I thought you'd get to the third one after asking the second one. Isn't that the whole point of the second one?
Yeah, to see basically what they do and then put them in place and figure out whether they should buy you drinks. But basically, yeah, this idea here that we're looking at, $225,000 for a base salary? After your third year. It raises a question about who they are competing with, too, for talent. I mean, how much is this competing with Facebook, with Google, in order to get some people, tech firms,
Well,
right?
they've been saying for a while, Katie, we're tech firms too, and no one's been buying that.
Yep.
I think with that salary push, things might change.
Can Bloomberg count as a tech firm?
Would you like
Sounds like
it to?
something I'd like to get in on. Maybe.
Are you going somewhere with this, Kaylee? By all means, carry on. We're out of time, apparently. Kelly
We'll leave it
Lights,
there.
Lisa Abramowicz, Jonathan Ferro. Coming up on this market, yields 132.38 on 10s. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio Friday morning. Good morning. Here's the price action this Friday morning. Bit of a tongue twister that. Equity futures 43.58 on the S&P. We advanced 6 points, up a little more than 0.1%. Nasdaq into this week, positive for 8 straight weeks. We're down just coming into Friday by 0.2%. Could take a bite of that out of the open, though. Equity futures on the Nasdaq up 25, advancing 0.17. Switch up the board and get to the bond market. 2s, 10s and 30s. We've been working our way through this bond market all morning, struggling to find a consensus. And Lisa and I discussed it earlier. Maybe the consensus is now that the consensus around this bond market is just totally broken down. Everybody has a view, and it seems to be very split one way or the other. What on earth is going on and why we're down through 132. A break of 130 briefly in the last 24 hours. Again, right now, 131.87. Yields on a session higher by a couple of basis points. On the week, lower. We closed out last Friday at 135.95. So just a couple of basis points lower through a week where we had hot CPI and hot PPI too. This is what I want to finish on, though. This chart. 2s, 10s. The curve in the Treasury curve. The distance between a 2-year yield and a 10-year yield. And back out into the end of March, that was wide, pushing 160, wide relative to where we are right now. 50 basis points lower. At the moment, we're at 108 basis points on a US 2s-10s curve. And I think the call of the week came from Steve Major of HSBC. And it goes a little something like this. Every single cycle, we add more debt to this economy. And every single cycle, the peak for interest rates is a little bit lower, because every single cycle, our tolerance for higher interest rates is diminished. And in Steve Major's words, we cannot afford higher interest rates. And therefore, Lisa, in his mind, maybe we've seen a peak. Yes, really, already, maybe we've seen a peak in that 2s-10s curve, not for the year, but for the cycle.
And just to build on that idea, not only is it potentially that we cannot afford higher rates, it's also, do the current circumstances end up suppressing growth long term and actually reducing growth? I mean, I'm thinking about Delta. I keep going back to this. Using their free cash flow to buy back $1 billion of pandemic-era debt, that is money that could have gone toward investments, toward other things that could have generated further growth. How much are we suppressing growth long term? This is a major question Ed Al-Husseini, I'm sure, has been thinking about. Columbia Threadneedle global rates strategist, joining us now on the phone. Ed, can you give us a sense of the interpretation of that yield curve that John was just showing? The idea here that we're seeing this gap narrow. How much, John? I think that we're having some issues with Ed, so we'll get to him in 1 second.
You
We'll
didn't
get
want
his
to answer
views.
the question, Lisa.
The question is it a matter of a Fed policy error, or is it a question of long-term growth simply being lower for longer? Period, full stop, regardless of what the Fed does?
I'll start with where I was last week coming into this week, because I think that will help frame where I was coming from going into that print on Wednesday. Was it Wednesday or Tuesday we had CPI? It was Tuesday, right? Mm-hmm. CPI came in hotter. Last week, the big discussion I had with everyone in fixed income, I'm not interested in the data. I want to understand how the market will respond to that information. If we had a hotter CPI print, what would the bond yield curve do? Would curves be steeper or flatter? Would yields be higher or lower? In the initial aftermath of that hotter than expected CPI print, what we had, Lisa, was a flatter curve. And what we had at the front end was a bit of a sell-off, yields higher. And that spoke to this idea that hotter inflation would bring the Fed in early and choke off growth. This idea that front-end yields would rise and long-end yields would fall. 10s, 30s lower, yields higher at the front end, curve flatter. And then we had that really messy auction on the 30-year, literally 3, 4, 5 hours after that, and the story changed completely. So my mind, I came in with just a little bit of confidence about how I thought things were changing, about the reaction function of this market. And then after the 30-year auction and the mess that we had in the 24 hours after that, I'm as confused as the next person. I have no confidence or conviction what is happening in this bond market at the moment and how it responds to any given data point. Inflation, hotter, cooler, take your pick.
Well, you and me both, and I think a lot of people in the market. And so let's ask Ed Al-Husseini that question. How do you interpret the flatter yield curve that we see this week and for the past few?
Hey, guys. I think it's been, this is that pattern in play since really the end of March. So it's been a persistent move in the curve, and there's a couple of factors in play. I mean, first, I think the rise in real yields in the first quarter of this year, in retrospect, perhaps was a little bit too excessive, and therefore the steepening that we saw on the curve in that time period is being unwound. I think we're halfway through. Second, there was a lot of optimism around fiscal policy. And I think it was correctly placed, particularly after the Georgia Senate elections. We opened up a very broad window for fiscal possibilities. I think that window is narrowing. I think there's some skepticism around further fiscal stimulus coming through. And to that end, the infrastructure package is not near-term fiscal stimulus. It's a long-term piece of policy. So on the margin, I think markets are looking ahead and seeing both fiscal and monetary policy start to roll over. Monetary policy, very likely we will start to see that taper kick in next year. We can argue about the timing, but I think it's clearly on the horizon here. And fiscal policy is going to step down. We pumped in about 25% of GDP over the course of the past, 15 months or so. That fiscal impetus is going to be down to about 2% of GDP next year. So it's a big step down. And I think markets are becoming open to the possibility that, once the fiscal stimulus is out of the system, we will return to trend a lot faster than we anticipated in the first quarter of this year. And I think that's been kind of the big driver of the curve flattening here.
And if we go back to trend, does a 10-year have a one handle? We back to 1%, 1 something, as opposed to 2 something?
The jury is out on that. And the reason I say the jury is out here is, look, at the moment, we're probably all struggling a little bit to come up with a narrative that steepens the curve, right? As you were saying, it's likely as the Fed is brought forward in response to more sort of higher inflation, it's very likely that it flattens the curve, and we bring forward that hiking cycle. I think really there's sort of three pathways in my mind to a steeper curve from here. First, we get some leadership from outside of the U.S. Rates have been depressed in Europe. The growth story there remains challenged. The fiscal story is significantly weaker in Europe. All of those things might accelerate in the second half of the year, potentially next year. And so if global rates rise, and we are starting to see some of the smaller G10 central banks pull back on accommodation as they recover faster, will we get some spillover from those rates markets into the long end of the curve? That's happened in the past, but it's relatively rare.
So what are the catalysts that really matter for this bond market? John asked the question, is it the data? What is it?
I think the bulk of it is fiscal policy and monetary policy at this stage. It's very little in terms of near-term data. I have very little confidence that we are going to move the market because the signal-to-noise ratio is exceptionally low in both employment and inflation data at the moment. And we've known that this is where we were headed at the start of the year. We are sort of at a point where I think the data is sending multiple signals. They may all be, there's an element of truth to some of them. But we won't know really until optimistically the end of the year and more realistically the summer of next year in terms of what is the underlying inflation story. Is it just a return to trend, which we're seeing at a very accelerated pace in components of it that have been affected by the pandemic? Or are we changing the trend? Are we shifting gears into inflation sort of in the 2 to 3% range, which is where the Fed wants to see it? We won't know until, I suspect, the middle of next year.
So let's talk about a C word, and we're not talking consensus. Let's talk about the breakdown in consensus leading to a lack of conviction for a lot of people. What is your highest conviction call right now, Ed? We really like the belly of the curve. I think if you look across the curve, the flattening has and the pricing of the Fed cycle has really made carry attractive, right around the 5-year point of the curve. And we think the Fed is patient enough that it buys us some time before that front end of the curve starts to move up aggressively. And so I like the protection that carry offers if you're switching out of a flattening theme in the curve. The long end, to me, is, roughly fair. If I think of sort of the next 25 basis point move in the 30-year yield space, roughly same odds up or down after the flattening. But the belly of the curve offers, I think, much better value and better protection.
Ed, good to catch up, as always. Ed Al-Husseini there, the Columbia Threadneedle global rate strategist on a bond market that's generated a huge amount of debate. The other debate we need to stay on top of are the restrictions around the pandemic. Kayleigh, I know you've been on top of this story, working with Francine earlier in the morning. The restrictions in the UK, some news coming from the Telegraph that JP Morgan and Goldman staff will be told to wear masks in UK offices even after those restrictions get moved around in the UK in the next week.
Well, and it's not just in the UK, John. If you live in LA County, you better put your mask on inside, even if you are vaccinated. The rules keep evolving and changing. The messaging isn't really entirely clear, especially around this Delta variant. As that situation evolves and that spreads, John, it seems that what we're being told we have to do is just constantly changing, whether you've had your shots or not.
Are we moving forwards here, Lisa? Are we moving just a little bit backwards? Is this a baby step backwards? And I'm not talking about the UK. I'm alluding to LA County.
Well, and there's a question also, and you've been asking it, what does this do in terms of enticing people to get vaccinated if they have to continue wearing masks anyway? I'm curious, especially as you get the likes of Bank of America and Morgan Stanley saying to their workers, hey, get back to the office. We're going to pay you more, but get back to the office. How does this complicate that, given the fact that people are now being ordered to wear masks? I mean, it's not very pleasant.
This is a divisive story. Another really divisive story, and I'm going to call it that. The most divisive story in business right now. Billionaires going to space, Lisa. I honestly think that is one of the most divisive stories of this moment. We'll have some special coverage for you on Tuesday. Blue Origin's rocket going into space with Jeff Bezos. That coverage starts at 8:30 Eastern time. And believe it or not, can you imagine paying $30 million for a ticket for something and then saying, Lisa, you have a scheduling conflict?
Well, I can't imagine paying $30 million for anything.
But then, Kaylee, what's the scheduling conflict?
Unless you're getting married or having a baby, I do not think there is an excuse to not get on your seat to space.
Getting married? Maybe.
Or do it in space.
That's a scheduling conflict. That's not getting married. That's a decent excuse, isn't it?
Just randomly schedule a
$30
marriage.
million for a ticket to something you've had to delay on. That's what this individual has done. He has a scheduling conflict and he will not be on that rocket this Tuesday. Amazing. People and money. Equity futures, 43.57, up a little more than a tenth. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In California, Los Angeles County told residents they must wear masks indoors, even if they're vaccinated. Authorities are reacting to a surge in COVID cases and the spread of the highly contagious Delta variant. LA County added 1,000 new cases yesterday for the 7th day in a row. 10 million people live there. And the UK is holding out the prospect of restoring some of its pandemic restrictions. That comes just 3 days before it plans to drop all social distancing rules. The number of people hospitalized in the UK with COVID has risen 43% in a week. The country's Solicitor General told Sky News that if the situation becomes, quote, unacceptable, some restrictions could be reimposed. In Cuba, the communist government is promising it will learn from the rare mass protests over the weekend. Authorities will temporarily ease restrictions on food and medicine imports. Thousands of people took to the streets to demand freedom and food. Cuba's economy shrank 11% last year. And Intel reportedly is exploring a deal to buy semiconductor manufacturer Global Foundries. According to the Wall Street Journal, the company could be valued at about $30 billion. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think we're in a situation where we can taper, and I think setting those parameters the right way. We don't want to jar markets or anything, but I think it is time to end these emergency measures.
I know the line of that, the piece of that Lisa is focused on. I'll return to that in a moment. That was James Bullard, the Federal Reserve Bank of St. Louis president, sitting down with Michael McKee in the past 24 hours, live on TV and radio from New York for our audience worldwide, alongside Lisa Abramowicz. I'm Jonathan Ferro. Tom Keene back with us on Monday. Lisa going away for a week. It's musical chairs filling in. Katie Lyons for today. Through the next hour on this program, equity futures 43.58 on the S&P. We advanced 6 points, a little more than a tenth of 1%. Yields come up 2 basis points, 132 on 10s. We have had a week full of Fed speak. So let's pick up on the line that jumped out for you, Lisa. I imagine it was the, quote, we don't want to jar markets or anything. Close quote. Is that the right line that I picked up on?
Nailed it. The question is, how do they do this, right? I mean, how do they signal tapering without jarring markets? And what counts as jarring markets? Is it that perhaps we don't hit another record high, or is it going to be actually something that's disruptive enough to threaten the economy in some kind of fundamental way? What is the threshold for that, John? And how much are they considering that as they take a look at housing prices at record highs, inflation reads that even Jay Powell was saying have come in surprisingly hot, and that they are watching to see whether it truly is transitory? Yes, that is what stood out to me. You nailed it.
I did like what President Bullard did, though. He talked about the context for the original decision, the emergency, the crisis they faced, the possible depression that they faced, and how we were no longer in that moment, and therefore we should reduce purchases. And I think that's a pretty decent argument to go to the FOMC with in the next couple of months. on this meeting that's coming up or the one after that too, Lisa?
You know what I do every Thursday at 4:30 p.m.?
You look at the balance sheet. I know exactly what you do at 4:30.
I look at the Fed's balance sheet because that is the most exciting thing to be doing at 4:30 p.m. Eastern time on a Thursday. And it hit a new record yesterday, $8.2 trillion. And you have to wonder, at a time when we hit new record highs with the longest streak of records going back to 1997 for the S&P 500 with record low borrowing costs for junk-rated companies, you do wonder, what is the purpose at this point?
What do we get for $120 billion a month that we wouldn't get for 0, 20, 40, 60? And Kayleigh, Mike McKee's asked that question continuously to Fed officials in Fed news conferences again and again and again.
Yeah, and I wonder when we're going to start get to see more inconsistency with their answers, John, because Lisa was talking about the messaging we got from Powell this week, and I would like to say that he was just kind of sticking with the party line, but I'm wondering if it really is the party line or if it's just Fed Chair Powell's line, because the tone he was striking seemed different to me than the tone Jim Bullard was striking earlier this week here on Bloomberg Television.
That divide ever present, and it's growing a little bit louder, and I have to say we haven't heard from Vice Chair Rich Clarida very recently. Someone mentioned that to me in the last couple of days, and I think that's an important point. Where is Vice Chair Rich Clarida on some of these themes? Lisa, a question we have to ask, though. If these issues with inflation data right now, hotter than expected CPI, hotter than expected PPI, if they're all traced back to supply-side issue, bottlenecks, etc., if the Fed scales back QE, what does it do? What does it actually achieve to the dynamics that we're talking about right now?
Which is the reason why, and I actually really liked what Ed Al-Husseini had to say, that this is actually more a statement on less fiscal stimulus going forward in terms of the flattening yield curve, in terms of slowing expectations or reversion to the mean than any kind of Fed accident. Because what does Fed policy actually achieve at this moment, whether it's easier or whether it's tighter, given where we are in the cycle and given some of the pressures that are causing inflation to rise?
We had a Bloomberg subscriber write in as that interview was going on. He loved the line, quote, the Joe Manchin flattening in the bond market. You willing to call it that, Lisa?
I think that there are people growing, increasingly looking at the size of the potential infrastructure spending plan. And it's gone down from what? At the beginning of the year, what were we talking about? $6 trillion even? And now we're talking about maybe $1 trillion getting through on a bipartisan level, and then perhaps a wish list being tacked on after that.
That yield curve, a big story for this equity market. This bond market set up what this stock market has done in the last couple of months. That divide between big tech, what's happened elsewhere with the small caps. I'm pleased to say our stock editor Dave Wilson taking a look at that. Dave, walk me through it. You're thinking at the moment, the NASDAQ, the big gains we've seen for big tech up until recently, going into earnings season, a couple of weeks away for these names.
Yeah, that's right. And we've really seen some fluctuation in the strength of tech stocks lately. And it's something that really jumps out when you look at the NASDAQ 100 index relative to the S&P 500, which Michael Schall over at Marketfield Asset Management did in a report yesterday. You saw the ratio get to a record in February. So that's really when the tech stocks, you could argue, peaked. Then it came down into the middle of May, and since then, it's been up about 7%. So the way that Schall's looking at it, and I'm quoting here, there will be no room for forgiveness when it comes to tech earnings, simply because you've seen this renewed strength in the group. And actually, if you kind of move beyond this comparison and look at the S&P 500 Information Technology Index, you find out that based on historical earnings, it's the most expensive it's been since 2004. Now, if you look at it based on projected earnings, it's a little more reasonable, but still on the high end relative to the rest of the 11 main industry groups in the S&P 500. It's kind of been in the high 20s for about a year now.
Yeah, well, Dave, and a lot of people have pointed to long big tech as a very crowded trade, the most crowded trade in the latest Bank of America fund manager survey. However, how much has the strength in these equities been driven by a renewed consensus that yields would remain low for the foreseeable future?
Well, that's definitely part of the mix, because we had seen concern pop up in the last few months that, you know, as Treasury yields rose, that there would be less incentive to own, you know, technology stocks. A lot of them don't pay dividends for starters, but that's kind of shifted away. And then beyond that, I mean, we've had the broader transition back toward the faster growing companies and away from the cheaper stocks. So in other words, growth reasserting itself relative to value after having kind of fallen back in the last few months.
Hey, Dave, good stuff. Looking forward to the big numbers coming from big tech a couple of weeks away. Dave Wilson, our stocks editor. Really great to catch up with Ed Al-Husseini about 20 minutes ago on this bond market, on this program. He writes in again, something to explore, and I think this is important. Lisa, Kaylee, your thoughts would be great here. The long end yields and the decline in them has happened without any changes in risk. Credit spreads remain tight, the S&P 500 near record highs, and all this has done is exacerbated the positive stock Treasury correlation, and this is a problem for asset allocators. And I think it's a good point worth exploring a little bit more, Lisa.
This is the reason why people have pointed to, and I am going to get hate mail, but Bitcoin and certain other commodities as an asset class that's less correlated. And this really has been one of the angsty points underpinning a lack of conviction in the 60-40 portfolio. But going forward, again, this goes to Margie Patel's point, John. Have we divorced the credit cycle from fundamentals? Have we actually squashed the credit cycle? And frankly, the lower that yields remain, the more risk on that it will be for the foreseeable future, and that will not change for perhaps years.
Your take, Kaylee?
Bitcoin is the 40 in a portfolio. I'm just stuck on that.
Is that the 40 in a portfolio? Is that where Lisa was going?
I don't know. Part of it playing a role that bonds maybe can't right now. I think it is an interesting question, John. And the narrative seemed to be that a lot of the reason we've seen long end yields coming in had to do with some shorts getting squeezed out, positioning changing. Is that still the narrative, or is this something else entirely?
Kelly Lyons, Lisa Abramowicz, Jonathan Ferro, one more round to go for them to get to their weekend. From New York City this morning, Good morning. For our audience worldwide, I'm joking, Lisa.
No way.
On TV and radio. I'm not implying you don't do any work after 9 o'clock, all right? Futures up a little more than 0.1% on the S&P. Yields higher by 2 basis points to 130, 171 on 10s. From New York, heard on radio, seen on TV, this is Bloomberg.
We think that the Fed is correct, right? That inflation is transitory.
One of the key questions is really, are stocks in a bubble? I don't think stocks are in a bubble, but they are expensive.
We don't want to jar markets or anything, but I think it is time to end these emergency measures.
If you do get this sort of sense from the Federal Reserve towards August, September, that they're looking towards tapering their asset purchases, a lot of traders are going to be caught off guard.
I don't think we have a cycle anymore. I think the Fed determines that we're on you might say, a secular path of low growth around a very, very low range of yields.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Economic data incoming from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Tom Keene is back with us on Monday. With us through the next hour is Kaylee Lyons. Your equity market looks like this at 43.59 on the S&P. We advance a little more than 0.1%. Lisa, let's reset and get ready. 30 minutes away from retail sales.
And the key question in my mind is, what data matters? Does this data actually have significance? The other data points, including much hotter than expected inflation prints, does not. Is consumer king? Can we glean what the future spending types of trends will be as we get these retail sales figures?
And how much tolerance is there for those higher prices that aren't being passed on, Lisa, to the end consumer?
I think that's a really key point. In other words, how much does the inflation that we have seen so far lead to slower growth long term? We've seen this with lumber prices. They've self-corrected. What's the cure to high prices? High prices, people buy less of it. How much do we start to see that in the data that comes out in 30 minutes time?
And we've seen scarcity weigh on output. I think we saw that in industrial production yesterday afternoon, Lisa. That's one to watch too.
Yeah, the idea here is how much are goods purchases declining simply because there are not the goods available. Somebody put out a photograph of Dick's Sporting Goods saying that they were looking for a kayak, and it just showed empty shelves across the board. That was yesterday.
And trying to find the people to get out of that kayak and go to work, maybe. That's been a big issue too. That's been a massive issue over the last. You're going away next week, so we can't get you to work. Kelly Lyons, have we learned anything from the data this week? Is there a clean story to talk about?
I don't think there's been a clean story for quite some time, John. The data just is incredibly messy, and I am interested to this point about the consumer and pricing pressures. Discretionary income, your dollar just isn't going as far in getting you the goods you want right now. When you look at disposable income and adjusted for inflation, it's at lows we haven't seen since before the financial crisis. So the consumer is seeing their spending power really taking a hit here, and when is that actually going to show up in the spending we are seeing in this U.S. economy?
We've got a big conversation to have on this bond market. We'll do that with a great guest in just a moment. Here's the equity market shaping up as follows this Friday morning. Good morning to you all. Equity futures 43.59, up 7 points. We advance a little more than 0.1%. Yields are higher. The curve is steepening just a little bit. It's higher after being flatter. Yields lower through this week again, 132.21 on 10s. Outside of that in the FX market, a break of 118 on euro dollar, 117.95. We show a little bit of dollar strength. Euro dollar down a little more than 0.1%. But Lisa, we keep coming back to it. It's just this 10-year yield getting comfortable in and around 130.
And there's a question about why. Is it because of a potential Fed accident policy error, or is it because growth is just going to revert to a slower new normal because we cannot afford, in the words of Stephen Major of HSBC that you quoted earlier, we cannot afford higher rates at this point?
Can we afford higher rates? Let's ask that question to Robert Tipp, PGIM Fixed Income Chief Investment Strategist and Head of Global Bonds. Rob, Steve Major of HSBC says we cannot afford higher rates, that this might be the cycle peak for the yield curve already. What do you say?
Yeah, I think we have seen the peak in rates probably for this cycle. There could be another twin peak later on. But I think that is one of the underpinnings of the long-term decline, secular decline in rates, aging demographics, and high debt burdens. That economies that are incredibly indebted, and there's been a secular rise in debt-to-GDP ratios across the developed world, and the upshot of that is you simply cannot afford the higher interest rates that you had before. So I think it's entirely reasonable to expect we're going to get a lower peak for rates in the cycle than last time, and we've probably already seen it.
Rob, is that consensus at this point? I mean, that's a pretty bold call that you and Steve Major over at HSBC are making, that we have seen the peak in 10-year Treasury yields for this economic cycle. Are people prepared for that?
Yeah, well, it isn't and it is. If you ask forecasters, and forecasters have been consistently too bearish on the market, they would say, no, you're going to see 2% or what have you. And that's entirely reasonable given the economic picture that you're looking at. But if you look at the market, you look at the price action in the market, you're seeing something that you haven't seen for decades or even hundreds of years, which is an interest rate cycle that runs almost exclusively through the front end of the yield curve. So when you're on the gold standard, there was faith that the central bank would control inflation because the fiscal could not get out of control. The back end of the yield curve would be relatively stable as short rates would go up and down. And you didn't see that in 1994. You didn't see that in 2013. When there was a fear of the Fed raising rates, the entire yield curve went up. But what we've seen this time with the dot plot, and the dot plot, I think, has been a nuisance for the Fed for a long time in a lot of ways, or at least for people trying to explain what's going on there. But seeing those scenarios where if you have high inflation, the Fed is going to get into action. You already have a large swath of the participants at that meeting that are ready to go. And what you saw in the back end was the market said, we have faith that in a overheating scenario, the Fed is going to contain inflation, and therefore long rates do not need to go up. And in fact, if the Fed is a balanced group, and up until this point, I think the market had been leaning towards they're going to stay on hold too long and let inflation get away. If this is a balanced group, then we're going to have lower growth than we expected 6 months ago in the long run, and you're going to have lower rates in the long run.
Talking about lower growth, let's talk about real yields. We're sitting in the ballpark of negative 105 basis points. Will they go even more deeply negative?
Well, I think the thing that people have to wrap their mind around is you're kind of in a new permanent area for real rates. I mean, in my view, the Fed funds rate is just about zero now. The peak of the last cycle was around 2 3/8. The peak this cycle will probably be significantly lower than that because of these secular fundamentals. And if you're going to be averaging a Fed funds rate that's maybe 0.5% or 1% or less, the cash rate in real terms is going to be significantly negative the vast majority of the time. And you have to get used to seeing a negative real yield term structure. So yields are going to be in these lower range. When things are really bad, maybe the 10-year rallies to 0.5%. And as we're seeing, if the economy is searing hot and inflation is soaring, you might get a 2% 10-year. And if that's the case, and inflation on average is 2% on the CPI, there's going to be a lot of negative real yields.
Some ifs and buts there, Rob. So let's put a bow on this all. We started this conversation by asking you whether you think we've seen a cycle peak in yields. You suggested we had. I want to just really make it clear where you're positioned on credit and how it relates to that view on yields and making that cycle call already.
Right. Well, I think, what we've typically seen is that you get an economic recovery, you have a big tightening in spreads, but as that economic recovery progresses, that spreads tend to stay fairly narrow, and that's likely to be the case this time. Now, the one thing we haven't talked about is that taper. And I think, summers are a difficult period for the market. And what we're kind of setting up for right now is to get to August, have interest rates pretty low, and have the Fed come in and shock the market with their taper announcement. So, I think, this is going to be a transition year. That's been our view all year of where rates are cresting. I think we have seen the highs, but it's not going to be a completely smooth ride as we go forward. And that'll jar credit a bit as we go through. But in general, looking 12 to 24 months out, I think you're going to get some additional outperformance from credit. And the surprising thing that we've been saying and believe to be the case 12 to 24 months out is that the yield, the roll down, that duration portion of the bond market is also going to contribute. And people staying at their strategic asset allocations are probably going to get the best results.
Rob, a lot of people watching the show have probably thought it has become bond show today because that has been where the entire focus has been. But that's where the focus has been for equities, too. And when you say that monetary policy may be executed entirely on the front end during this cycle, it makes me think that we're going to see a much flatter yield curve going forward, if that is the case, which is a bad thing for banks, which has been a big call for a lot of equity investors. Is that what you're saying, that we've already seen the peak in yield curve steepening?
Yeah, I think so. Yeah, I mean, if long rates on the 10-year are going to be peaking, sub 2%, bouncing around in this area. Typically financials, they like to see higher yields, and that doesn't look to be in the cards. It looks like you're going to have stability. The one thing that the credit cycle has going for it, and that would include financials, is the really good asset performance. There are concerns about asset quality as at the early stages of the crisis. And I think a lot of those concerns, are falling by the wayside as we go forward and as we get information, from the banks going on here. So I think the underlying fundamentals of an expanding economy, of corporations that have liquefied, that are able to roll out debt, extend their maturities out, continues to provide a background where there are a lot of opportunities across the credit spectrum from local and hard currency emerging markets, investment grade and high yield corporate bonds, as well as structured products.
Rob, good to catch up. I love the team at PGIM. They always come out with a call, a proper call. Robert Tipp of PGIM. Rob, good to hear from you, mate. Good to see you too. Lisa, that is a real call. Cycle peak for yield, cycle peak maybe for the yield curve too.
And these are some of the behemoths in debt markets when we talk about Stephen Major of HSBC, who's gotten it right again and again. PGIM Fixed Income, which also has gotten it right, notably quite consistently throughout the year. What does this mean for that financials play if you've already seen the peak in the yield curve?
It's difficult. I've asked all week, what do you need? Higher yields or yields just to stop going lower? I think they've lowered the bar. They just want them to stop going lower. They're higher this morning by a basis point or two to 131.54. From New York City this morning, good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Together this morning with Katie Lyons. Your equity market, 43.59. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration today warned U.S. companies about the risks of doing business in Hong Kong. An advisory said that China's push to exert more control over the financial hub threatens the rule of law and endangers employees and data. Today's move underscores how quickly that Beijing's promise of one country, two systems in dealing with Hong Kong has come to an end. Meanwhile, President Biden and China's Xi Jinping will address APEC leaders at a virtual summit on the pandemic today. APEC has 21 members, including the US, China, Japan, Australia, and Canada. Whilst the virus is the topic, the meeting is bound to reflect rising tensions between the US and China. There may be an upside for Republican candidates criticized by former President Trump. 3 of them who have faced his wrath raised more money in the second quarter than the challengers in their races that he endorsed. They include Senator Lisa Murkowski of Alaska, Congressman Anthony Gonzalez of Ohio, and Katie Britt, who's running for senator from Alabama. In Germany, more than 100 people have died in the worst flooding in decades. Many more people are missing. There are at least 15 deaths in Belgium, and other parts of Western Europe have also been hit. Several days of heavy rain forced rivers to overflow. People climbed onto rooftops and into trees after their houses were inundated or collapsed. And PJ Solomon is the latest Wall Street firm to raise salaries for young bankers. The new salaries range from $100,000 for first-year analysts to $225,000 for third-year associates. Citigroup, JP Morgan Chase, and Barclays are amongst those who have also increased pay for junior bankers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's in the process of being how soon we can lift the ban. It's in process now, and I'll be able to answer that question to you within the next several days, what is likely to happen. I'm waiting to hear from our folks and our COVID team as to when that should be done.
That was the President of the United States, several days. And you might have some kind of answer. What the answer is, we didn't really get a clue. From New York City this morning, good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro, together with Katie Lyons this morning. Here's your equity market, 43.61 on the S&P 500. In the FX market, 118. We're negative a tenth on euro dollar. At the moment in the equity market, we're positive 0.2%. Outside of that, into the bond market, yields are higher by a basis point or two to 131.54. So the President, Lisa, responding to a question about whether the travel ban would end, and we didn't get brushed aside as we sometimes do with that question. We actually got a bit of an answer about when we would get an answer.
Yeah, they're going to get an answer maybe in a couple of days. I love your skepticism, which is he didn't actually tell us what he was going to do, but at least he addressed the issue, which maybe is giving people optimism. At least you're seeing it a little bit in the shares of some of the airlines.
Well, let's get to them. Delta, United, American shaping up as follows in a pre-market. Katie, there's a lift here. It exists. We're up 1.5% on Delta. On United, up a little more than 1%. And likewise on American, Kaylee, we advanced 1.22%.
Yeah, it's a lift, John. It's not quite the lift you're getting for some of the European stocks. It is travel and leisure that is leading the way in the stock 600 today. The likes of IAG are up about 3% because those international carriers, those on the other side of the Atlantic, really have been hurting for quite some time, waiting for the day that they can once again bring European passengers back to the U.S. with no problems. And still, that day is not here. Maybe it'll come in a couple days, John.
Are we closer to that day? Let's bring in Mary Schlangenstein, shall we? Bloomberg News U.S. Airlines reporter. Mary, let's start there. In several days' time, how important is the answer to the question that was asked yesterday for these airlines?
It's very important for the airlines. In the United States in particular, domestic travel has come back really strongly, but they desperately need that European component, the international component, and they're focused on the travel between the U.S. and Europe. And traffic has been, inbound traffic from 26 European countries and the U.K. has been blocked since March of 2020. So they really want that valuable traffic back. Once those bans are lifted, people can start traveling, and that hopefully will lead to the resurgence of international business traffic.
The business line is the important one. And Mary, I just wonder, who's this more important for? Out of United, Delta, American, JetBlue into the mix as well more recently for the next couple of months. They'll be launching over in London, I believe. Is that next month, Mary? Just walk me through who that's important for.
Really for Delta and American, a little bit bigger across the Atlantic. United's bigger across the Pacific. And then, of course, for JetBlue, just the fact of whether they'll be able to start those routes to London from New York. I mean, that's critically important for them. They've bet a lot on doing that.
Mary, how strong is the lobbying arm of some of these airlines that have been talking to the White House? And how much have they been talking to the White House saying, can you please give us guidance on what your criteria are and what your thinking is?
Well, the lobbying arm for the U.S. airlines is pretty strong, and they're pretty effective. They do a pretty successful job on most of the things that they work on. Even just this week, Delta's CEO had expressed frustration. He said, we've been lobbying for months and months to at least open some travel corridors between the U.S. and the U.K. and the U.S. and Europe. And that CEO, Ed Bastian, said, we've kind of done all that we can do. We've been giving them information. And he was frustrated that U.S. travelers who've been vaccinated vaccinated can go to Europe, but they can't bring those people back to the United States.
Yeah, that's definitely been an issue where U.S. citizens can go over to Europe, like Kaylee and I went on the same plane. And Kaylee, I don't know if you noticed, I'm sure you did, it was completely packed. Yeah. Anytime you go on a plane, it is packed, even though people are concerned about the COVID crisis and even though people are wearing their masks. Every seat is filled, and you do wonder how long it's going to continue.
Yeah, I will have to say, for all our viewers and listeners out there, Lisa was about 30 rows ahead of me on the airplane.
I was not,
and I was on one of those.
Lisa, we don't cut people off on this program. Tom does that. Kaylee, you carry on.
And Lisa
you tell us
had
about
her
where
nice
Lisa was
little,
sat.
Her nice little two-person seat, window and aisle seat, and
go.
I was in the middle of the middle row, and all the seats around me were full. So there were definitely a lot of people traveling.
Mary's still here.
And Mary, I have to say, on that flight to Greece, what I paid for that round-trip ticket to Athens is only a little bit more expensive than what it cost me to buy a plane ticket from New York to Denver for my grandma's 80th birthday. Let's talk about the pricing power and the fares some of these airlines are charging. How are they able to exercise such intense pricing power right now?
Well, it's all a matter of supply and demand. You know, the airlines parked a lot of planes during the pandemic. They let a lot of staff take leaves. And so, you know, they're still bringing back planes. A lot of them don't fully have their fleet back. And the demand is so high that it's all a matter of supply and demand. You know, if people will pay the prices, they're going to raise the prices. You know, they've been losing money, a lot of money, since the start of the pandemic, and only now are starting to return to some profit with the help of the federal aid they got.
Well, you talk about the employees that they had to put on leave at the height of the pandemic, and there was a real struggle in getting those pilots back, getting the flight attendants back. Is that still a big issue?
The problem is the training that they required. You know, pilots who have been on leave for 6 months or 9 months, you know, when they come back, they have to go through their certification training again, or maybe they were moved to a different aircraft. Like that happened a lot at American. And so they have to be trained then on a new aircraft as well. And so that takes time. You know, most of the airlines have their simulator training going around the clock or pretty close to that. They're trying to get the pilots trained. American said they would have all of theirs trained by the end of June. But we know that that's still ongoing, and that's more the issue, is not so much of the number of pilots as it is getting them through training.
Mary, always good to catch up with you, and we appreciate your time this morning, that's for sure, on an important issue. Mary Schlangenstein there, Bloomberg News, U.S. Airlines reporter. Just as I'm plotting the chart on the S&P 500 airlines, 19.25% off the highs of the year. Lisa, that's a real correction that's developing, the airlines in America.
The deflation of the reflation trade, to talk about the consensus around the consensus falling apart. You know, talking about the derivative terms here, that has been also a theme. You do wonder how much of the recovery trade's already been priced in. And I do wonder how much this hangover effect of the debt, of some of the extra costs that these airlines have to pay in order to make their cabins safe, which for all intents and purposes, they've been proven out to be. You do wonder how much that will weigh on their profits, John.
Well, your thoughts on the move, Katie, and we can turn around to the profit story in just a moment, but the move itself, down 19, 20 percentage points off the highs, is that because we're not where we thought we would be 12 months ago, 12 months out? Is this the Delta variant and the way that's developing? What is that move?
It's maybe, or it's a move that ran too far ahead of itself in the beginning of the year and is now starting to unwind as it meets reality a little bit, because a lot of these reopening plays had run so far so fast, and we've seen them lose some steam. And it's not just true with the reopening plays, John. It's true with those cyclical plays as well. You saw a very similar phenomenon playing out with the Russell 2000.
We said this repeatedly coming into the new year when we saw cyclicals really pick up, small caps absolutely surge. Lisa, the distinction between a cyclical reopening trade that is shorter in duration and a longer-term sustainable cyclical play. Now, in the near term, it doesn't matter if you're making two different calls. That's the near-term price action. In the long term, it absolutely matters.
And if you pair what we're seeing in cyclicals with what we're seeing in bond yields, the story that you're getting is we are going to revert to the old normal of slow growth and perhaps even slower growth because of the debt overhang.
Dun, dun, dun. You need the music. You need the music with Lisa. So I miss Tom for that, the sound effects.
It's true, though. I mean, that's the interpretation.
43.62 on the S&P 500. Futures up 10 points, advancing 0.2%. Retail sales in America coming up next. From New York on radio, on TV, this is Bloomberg. From New York City, live from New York for our audience worldwide, on radio, on TV, this is Bloomberg Surveillance. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Together this morning with Katie Lyons, waiting for some economic data in America. Retail sales are coming. Clearly, we all need to get to the weekend.
Amen.
Thank you. Mike McKee, that data's still not out, sir. Run us through what you're looking for.
We're looking for maybe a slight decline in retail sales after a strong month last month. But retail sales are always difficult to forecast because they do get adjusted a lot. They get revised quite often because only about half the data is in by the time they put this report together. So we will look not only for the monthly number, but we'll look for the revised number. And here they are. Retail sales up 0.6%. That's much better than the 0.3% that was anticipated. And so it looks like this month we had a strong showing by the American consumer. Retail sales ex autos is up 1.3%. Autos has been a tough spot because the availability of cars has been very small. And then you look at the control group. I don't have that one out yet, but oh, there we go, 1.1%. That's the number that sort of feeds into GDP. So that's better than the 0.4 expected and better than the decline of 0.7 that we saw last month. So a very good report now on retail sales that adds to the debate about what the Fed should do, because this one better than expected. All the data coming in stronger as the economy reopens. And of course, this is not a month where people got stimulus checks, so they're probably spending down some of the money they put into the bank.
We've got a hot economy right now. And Mike, just quickly, this is how the market responds to it. Yields higher through the curve, up 2 basis points on 2s to 24 basis points on 10s, up a couple of basis points. Yields were elevated going into the print. Make note of that. Up 2 basis points on 10s, still by 2 basis points to 132 on 30s. 194 pushing 195, up a couple of basis points there as well. So it's an upside surprise on CPI, Mike. It's an upside surprise on PPI. It's an upside surprise on retail sales. Just sum it all up for us.
The economy is strong. What we didn't know is how everybody would react coming out of the pandemic recession, because we'd never seen anything like this before. And the feeling was the reopening would be a gradual rebuild as people got more confident in going out. But you look at some of the numbers here. For May to June, I'm just trying to make sure I don't get this wrong. Food and drinking places, which is kind of the ultimate of the discretionary purchases that we make, and we worried about whether people would want to go out in public or not, but they're up 2.3%, which is quite strong. From last year, up 40%. So people going back to get out and enjoying a good time. The other numbers that might be considered big here, gasoline stations, that's based on price, and that's up 2.3%. We know prices are up, but clothing and clothing accessories up 2.6%, and general merchandise stores up 1.9%, department stores 5.9%. So a lot of spending in the month of June, and it looks like Americans are trying to get back to normal as quickly as possible.
Mike McKee, thank you. Keep saying it. Enjoy yourself over there, wherever you are, in that undisclosed location going into the weekend. Mike McKee with your data. Let's run through the data. The control group for retail sales. Upside surprise, 1.1% against an estimate of 0.4. The previous month revised lower from negative 0.7 to negative 1.4%. But it's hot, hot, hot. That's the story right now, Lisa. On PPI at the factory gate, price is higher. For the end consumer, price is higher. And the spending, there's a consumer price tolerance in the mix as well that we have to take note of.
I want to just highlight the fact that the yield curve, the gap between 2- and 10-year yields, has flattened further, that basically it's toggling around from actually being is tighter on the day. And this goes back to Robert Tipp's point of PGIM, when he was saying that any reaction in monetary policy will be on the front end, higher front end yields, and that is what we're seeing priced into the market today. And the end result is still a slower economic growth picture.
And still an equity market that's doing okay. Up 10 points on the S&P. Kaylee, we advanced on the NASDAQ 100 too, up 41, advancing about 1/3 of 1%.
We do indeed, John, just kind of feeding onto the risk-on tone that had been developing throughout the futures session. But I think your point about the consumer and their spending resilience is a really interesting one, because we talk about the fact that they're facing higher prices at the grocery store, at the gas station. Companies are passing on their higher input costs to the consumer. And when you adjust for inflation, consumers' disposable income actually is going down, and yet they still seem willing to go out and spend, John.
Let's turn to David Page of AXA Investment Managers, the head of macroeconomics. Dave, let's start there. Just your response to the data, not just this morning, but through this week.
So I think you've got a very mixed bag. I mean, the consumer, thankfully, actually coming through reasonably solidly here. But we have seen a relatively weak month-on-month quarter across Q2 after we'd seen that, obviously, that huge surge come through in March. What caught our eye over the last week has been the drop in weekly consumer confidence as well. We've seen the fastest retracement in consumer confidence over the last 3 weeks than we've seen since last December. So there's a really mixed bag here. Yes, you're seeing price pressures come through, but those we recognise to be frictions to the economy, not something that's necessarily reflecting, strong demand, but something that's actually sort of a headwind to growth, if you like. You've had industrial production a little bit softer than expected, manufacturing dipping again for the second time in the quarter. And some of the surveys, Empire State Survey yesterday, through the roof, series high. Others just starting to come off a little bit. And we think back to that non-manufacturing ISM, which also included a sharp drop in the employment number. And there are some pretty mixed messages come through here. Now, I think, the backdrop is Q2 GDP number looked pretty solid. We've been looking for 8% annualized for some time. We'll fine-tune on the back of these numbers, but it looks pretty consistent in that area. But I think that it's going to be slightly more challenging for Q3. And that's one of the things the Fed's going to be watching when it thinks about sort of trying to send that signal as to just when it needs to start.
We'll all be watching that, Dave. As you say, it's really hard to read the data. It's really hard to read what it should mean for the bond market too. Yields are higher by a couple of basis points, 1 or 2 through the curve here. But on the week, we've had that hot CPI, that hot PPI, that hot retail sales print, and yields are still lower on the week. A little bit earlier today, in fact 30 minutes ago, we asked Robert Tipper-Pejim whether he thinks we've seen a cycle peak in yields. Take a listen to what Rob had to say.
I think we have seen the peak in rates probably for this cycle. There could be another twin peak later on. But I think that is one of the underpinnings of the long-term decline, secular decline in rates, aging demographics, and high debt burdens.
David Page, your reaction to that sound, that response from Robert Tipper-Pejim?
Yeah, I think that's probably a little bit pessimistic for the outlook for growth. And I think one of the key issues here is going to be what comes through in terms of spending. We are expecting to see a very large stimulus package come through. It's not being as easy as Biden perhaps thought it might have been. But we are expecting to see in September the government actually put some significant spending programs in, which we think are going to lift potential growth for the US going further forwards. It's not a deficit finance argument. This is something that we think is actually money going where it needs to go in the US, where it's not gone for some time. And I think that's going to support the outlook. If we take a step back and think what the Fed thinks that the terminal rate for the Fed funds is 2.5%. Now, okay, we could have an argument around that, 25 basis points either side quite comfortably. But it's unusual to see bond yields topping out at such a low level if we think that the terminal rate is going to be north of 2%. And I think certainly as time goes by and as we get close to that point where we are going to see the Fed tightening, and we think that happens in 2023 and not any time later, as you get closer to that, then those 10-year yields and the 2 yields are all going to start to reflect those rates going higher. So I think it's up. To our minds, we're expecting to see yields rising. We think, back to 175 by the end of this year is likely, although I think it could be quite a long summer. But I think we'll see them climb higher than that as we move over the next year or so.
So what's the deciding factor here? Is what I'm hearing from you that it's more important to look at Washington, D.C. and what plan they might pass than any of the incoming data that come in, for the most part, hotter than expected or have been for the past few weeks?
No, I think what we've seen from D.C. is going to give the economy a significant rebound across the course of this year. I mean, we've been tailoring our forecast a little bit lower. We think 6.4% for 2021. But by and large, you're seeing a very strong rebound come through. You're going to see the economy move into a position of excess demand. And that's something that ultimately is going to govern how the Federal Reserve moves. Now, I think when we look to the longer term, there are questions about whether or not there's scarring in the economy, just how much readjustment the economy is going to have to take to get over this pandemic. But I think that's where you start looking at those longer term spending plans and you think, well, yes, there could be some downside, but there's possibly some upside coming through from here as well. So right. I think DC is important for the longer term, but I think in terms of what we're likely to see from the Fed and what we're likely to see from the economy over the next 6 months, the stimulus that's been injected into the economy already is the key feature here. But from markets, markets David, will always be forward-looking.
David Page of AXA Investment Management. Dave, good to catch up, sir, on this data. And this data, Kaylee, to David Page's point, has been hard to read. But for the big prints this week, I think you'd want to know where was CPI, where was PPI, and where was retail sales? And to sum things up, to conclude, they came in hot across the board.
Incredibly hot, John. I mean, we were looking on retail sales to fall by about 0.3%. Instead, they rise by an amount double that. Inflation coming in really, really hot. And John, when it comes to the Fed, which David Page was just talking about, we know that they're paying attention to the data. But my question is, does this data matter yet? Or are they waiting for some of the noise and some of the confusion around it to kind of come out? Are we more looking at the prices and the inflation numbers, the retail sales numbers in the fall, and those are the points that are going to matter more to the Fed?
It's the latter point that I think you've absolutely nailed, Kaylee. It's the calendar. It's the fall, it's September, it's October. Before we get a clean read on some of these issues, some of those distortions, Lisa, start to fade.
I think David Page just edified where we started the show, which was basically that consumer sentiment would be more important than retail sales. And he was saying that that came in a bit softer and that that's what the Fed was looking at. So at 10 a.m., in about an hour and 20 minutes, that is when perhaps we'll get a key data point that will actually matter more. I mean, really, this is interesting because it has more of a forward look, particularly consumer expectations for inflation. Just wanted to mention
I understand. You used the whole show just to confirm your priors and validate what you've already said. Kaylee, this is what Lisa does. This is what Lisa does, Kaylee.
And she
Get
does it
used
well,
to
John.
She does it very well.
Thanks.
She won't be doing it next week, though, because Lisa's away. This is also something that Lisa does, Kaylee. You both took a week off, then you come back for a week, and Lisa goes again.
I'm joining the Bears in the Adirondacks.
That's right. You're returning to your constituency,
Yes, exactly.
as I said a little bit earlier this week. Alongside Lisa Abramowicz, I'm Jonathan Ferro. A special thank you to Katie Lyons. They'll run you through to 9 o'clock. I'm going to run over to the TV studio. It's been good to be with you through the week. Catch me at the top of the hour on Bloomberg TV. Your equity market up 1/3%, up 12 points to 43.64. On this bond market, Priya Misra of TD. That's a big conversation coming up. On the open, just moments away. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In California, Los Angeles County told residents they must wear masks indoors, even if they're vaccinated. Authorities are reacting to a surge in COVID cases and the spread of the highly contagious Delta variant. LA County added 8,000 new cases yesterday for the 7th day in a row. 10 million people live there. In Cuba, the communist government is promising it will learn from the rare mass protests over the weekend. Authorities will temporarily ease restrictions on food and medicine imports. Thousands of people took to the streets to demand freedom and food. Cuba's economy shrank 11% last year. And the UK is holding out the prospect of restoring some of its pandemic restrictions. That comes just 3 days before it plans to drop all social distancing rules. The number of people hospitalized in the UK with COVID has risen 43% in a week alone. The country's Solicitor General told Sky News that if the situation becomes, quote, unacceptable, some restrictions could be reimposed. Moderna has closed at a record 3 of the 4 trading days so far this week. The vaccine maker is set to open at another record today after being added to the S&P 500 index late yesterday. Moderna was up 12% this week going into today. And Intel reportedly is exploring a deal to buy semiconductor manufacturer Global Foundries. According to the Wall Street Journal, the company could be valued at about $30 billion. It's controlled by Abu Dhabi's sovereign wealth. Mubadala in deal would boost Intel's plan to regain its one unmatched lead in chip production. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
My experience right now is the economy is strong and that there's a lot of pent-up demand. People are anxious to travel and to enjoy things again. They've been, for quite some time on lockdown or near lockdown. And so there's a lot of excitement and interest.
Arnold Donald, Chief Executive Officer of Carnival, talking about the reopening trade in travel. The reopening trade in cities was as big Wall Street firms try to tell people get back to work, if not now, starting in September. Lisa Abramowicz, Kaylee Lyons, John Farrow's gone off to his next property, The Open. And right now we have one of the most interesting interviews of the week, and that is the reopening trade in New York City at a time when we have all of the housing prices climb to record highs, surge at record paces, the housing shortage across America. It is not the case in the big coastal cities. Jonathan Miller has been covering this industry for decades at Miller Samuel. He's the president and chief executive officer with incredible data and insight into the trends. Do we have a housing shortage at this point in the big cities, given that we're starting to see a little bit of interest, or is there still a massive glut that needs to get filled?
I actually think it's somewhere in between. So, for example, in New York, we saw since January, when we had near record inventory, we've seen inventory fall about 25%. I think the way to look at urban markets around the country is that the suburbs got all the attention. That's where the outbound migration was initially. And so I would look at the cities. I'm not saying we return exactly to normal, but clearly elevated inventory levels are coming down, and we're seeing it's clearly not as tight. The suburbs are at record lows surrounding New York and other markets that we cover, but we're seeing inventory really fall sharply in the cities as well because purchase activity has skyrocketed from year ago levels, which was the lockdown period. But even when we compare 2 years ago, same period, we're looking at, for example, in Manhattan, sales are up about 15% over second quarter 2019 numbers.
But Jonathan, that's because everybody wants a deal. Have we seen the bottom in prices, or is these all the bottom feeders coming in to try to pick up things cheap?
I think the window is just about closed on that. If you look at at the aggregate numbers, you're really talking about a market that's within it's about 3 to 5% below what it was in the same period 2 years ago, which would be the pre-COVID sort of benchmark. And but that is really compressing. The one thing about the cities in general is that rental markets are generally hit much harder than purchase markets because renters are more flexible. They don't have to sell a property during a global pandemic. And what we're also seeing at the same time is in Manhattan specifically, we're seeing new leasing activity for the last 3 months has been at all-time record levels.
Yeah.
And so what that's doing is burning off the significant inventory. And actually, in some segments of the rental market, I'm not trying to be sort of sensational here, but we're actually seeing bidding wars on rental properties starting to emerge, which is highly unusual.
Jonathan, you're making me so glad I re-signed my lease when I did, because when I did it back in the spring, I got a couple months off. I got my monthly rate lowered. If I were to do that now, or if I were to try to do that now, they'd send me out the door because someone else is willing to pay more. And I live down in the financial district. It's gotten a lot busier over the past couple of months. But are people like me where they want to live kind of close to offices, close to the places that they work, or has COVID changed that? Are we seeing the places even within the city that people want to habitate different?
Right. So that's an excellent point, and we're actually seeing Wall Street firms, a number of the big ones, basically say, "Come back to work 5 days a week," and they're sort of ahead of the pack. One of the things we have to sort out is I think we're going to have corporate callbacks for employees are going to really ratchet up beginning in September and throughout the fall. And that's going to breathe a lot of oxygen into street level retail. And right now, as I always say, we're at peak Zoom. We're really, everything is sort of being recalibrated. One thing that really I think is a misunderstanding too is that work from home, that phrase implies to many work from the suburbs at home.
Right.
And that's not true. You're going to have plenty of people working remotely, a couple days a week from the Upper East Side or whatever neighborhood, just because of the sheer density of workers in the city.
So, Jonathan, Lisa and I are a little bit biased, and we think, New York maybe is the only market that matters because it's the one that matters to us. But you obviously cover a lot more throughout the country, including South Florida. And we've talked a lot here in New York about the flight to Florida. To what extent has that actually taken shape? What is demand looking like down there?
So Florida, just like most housing markets in the country, has a chronic lack of supply. An example, months of supply for luxury condominiums in Miami 2 years ago was something like 3 to 4 years to sell off. Now it's about 8 months. So there's been a tremendous absorption of all price points, but even the most problematic, which had been sort of the high-end market. And I think a big reason for that, I think the escape from New York sort of narrative is a little bit overblown because essentially I think Zoom or remote working has given corporate executives much more flexibility on where they have to be at any given time. And the way I described it is the tether between work and home has become infinitely longer, so there's a lot more flexibility. What's really different this time in Florida, and we cover about 14 housing markets there, is that besides the low inventory, is that we're seeing an inversion of what's performing. It's skewing, instead of softest at the top, it's actually inverted, and we're seeing the upper half of any given market. So we're seeing some big pricing in markets that we might not have seen before. Yeah. So it's not just a couple of locales; it's a big footprint.
Jonathan Miller, thank you so much for that insight. Jonathan Miller of Miller Samuel, President and Chief Executive Officer. Just fascinating to see how people are readjusting their sense of a post-pandemic reality, Kaylee. Perhaps working from home, perhaps those 3-bedroom, 4-bedroom townhouse types of homes getting more attraction than some others.
And getting more expensive, Lisa.
Yes.
If you wanted to buy one maybe a year ago, you would have been in luck.
Yeah.
Now,
You missed the boat. Basically, that was the message from this. So congratulations, Kaylee, on re-signing your lease and getting those perks. Right now, in the markets, we are seeing strength across the board, and I find this fascinating. Have we moved back to what Ed Al-Husseini was talking about, where basically bonds and stocks trade in tandem? You see the bonds, as they get stronger, stocks get a boost. We do see bonds a little bit weaker. The 10-year yield up just about 3 basis points, 1.327%. But S&P up solidly. Coming up on Balance of Power, I'll be moonlighting as Tom Keene, Jared Bernstein of the White House. This is Bloomberg Surveillance.